So welcome everyone to Foley Hoag. We are a proud sponsor of the Climate Adaptation Forum, and we are excited to kick off another year of hosting these gatherings here. As Johnny mentioned, I'm Kathleen Brill. I'm a partner here in our environmental, energy, and climate practices. In our energy and climate work, we're focused every day on applying our expertise in the range of technologies, business models, and strategies necessary to develop and deploy climate solutions at scale. Our environmental practice is increasingly focused on how to protect existing critical public assets and private development in the face of climate change, and how to plan future development and infrastructure to be more resilient. I'm excited to take us on a deep dive today into the role the insurance sector can play as a partner in achieving these ends. I'll provide you with an introduction to today's program shortly, but before I do, I wanted to take a pause to recognize a distinguished guest we have with us here today. We are delighted this morning to welcome David Cash, Regional Administrator of EPA Region 1 from 2022 through the beginning of this year. David has also served in multiple positions in Massachusetts state government, including as Director of various environmental programs, Undersecretary at EEA, and Commissioner of both the DPU and DEP. His work has helped to transform the Commonwealth's energy and environmental policy and regulatory landscape. And most impressive of all, or at least dearest to our hearts, David was a founder and early leader of this very Climate Adaptation Forum, moderating our first program 8 years ago. So I'm going to turn it over to David to just give us a little hope.
Thank you, Kathleen. That's why I have to give you a little hope. Okay. First of all, thanks, Anne, Gabriella, and Bob Chen is here, Jackson, the whole team that put this together 8 years ago has created this community. And I'm going to end, the hope is on this community. So I'm going to end on that. Also, a shout out to Rebecca Hurst, who was also there at the forming. Awesome. So, we're at this moment. We all know we're at this moment where the very foundations of the work that undergird everybody in this room, that is not just the acceptance, but the leaning on science and technology and engineering, evidence, facts, and the leaning on the law that provides the underpinning for everything from codes to emissions requirements to large-scale things like the Global Warming Solutions Act in this state are being questioned and threatened in a way that has never happened in my lifetime, and I don't think has ever happened in anybody's lifetime here in this country. And so first, related to that, I just want to give a shout out. I'm not going to ask you to raise your hand because of the bizarreness of the moment that we're in, but I know that there are folks who are either here or online who work for the federal government, work for state and municipal government. So can we just give a big shout out and gratitude for the incredible work that our federal, especially our federal employees, thank you. Thank you for the public service that you do. So many people are struggling with how do we get hope and optimism at this moment in this grim time. And I think it's largely through the kind of communities that you've created here. There's so many different perspectives here at the table, so many walks of life, so many different careers that are represented, so much smarts and expertise, and you can't let that stop. You can't buckle under whether your law firm or your corporation is nervous about what retribution there might be, or what government or if you're in government, what kind of retribution you might encounter from the federal government. You got to stand firm, have a backbone, fight back with the evidence and law that's behind you, because we do have that. That foundation is still here now. And those are the tools that we as a community need to continue to use. And it's wonderful to come back here to be part of this community, to know I'm part of this community, even though I've been gone for a number of years, but to sit in this space with all of you is such a pleasure and such an honor. So thank you, Kathleen.
Thank you, David. You hit the mark. So the idea for today's program emerged in part from last December's forum on financing for climate and adaptation. At that forum, our speakers touched briefly on the roles that the insurance industry can play as market signal, as influencer of federal policy, as provider of innovative products like parametric insurance that can break down barriers to accessing aid, and as a finance industry investor in climate resilience. There was keen interest from our audience and our steering committee in exploring this topic further. Since we started planning for this forum late last year, we have seen the role of the insurance sector in preparing for and responding to climate-related disasters take center stage in both the local and the national media. Recent analysis, as Njani mentioned, regarding last year found that in 2024 alone, natural disasters caused losses of $320 billion worldwide, one of the highest years on record, only $140 billion of which were insured. This speaks to both the increase in climate-related loss and the significant size of the protection gap. The LA fires have highlighted the gap associated with the underinsured, those insureds who hold policies whose payouts are insufficient to cover the cost of rebuilding. It also highlighted the challenges faced by homeowners who cannot find private insurers willing to provide them coverage, and so must resort to the state-run insurers of last resort, the FAIR plans, under which coverage caps are often lower than property values. Similarly, last year's storms in Florida exacerbated the pressures on an already fragile insurance market, where many insurers had already become insolvent or left the state entirely. Here in Massachusetts, homeowners are feeling the same pressures. The Boston Globe recently reported that in 2023, Massachusetts had the 5th highest non-renewal rate for homeowners insurance policies in the country. And in flood-prone areas, particularly Cape Cod and the islands, as many as 1 in 9 policies went unrenewed. I'm no expert on insurance, but it's been my pleasure, along with my co-chairs Kyle and Ellen, to put together today's program. We have already learned so much from today's speakers, experts, and visionaries, and we're really excited for you to learn from them too. So for today, after some recorded remarks from Senator Sheldon Whitehouse, we're going to hear from Charlie Sadati of Insure and Professor Michael Beck from UC Santa Cruz, who will share with us their ideas for reimagining insurance markets and pairing nature-based solutions with insurance incentives. We'll take a short break for networking and then return to hear from Ben McNeil from Swiss Re and Theodora Macris from the Center of New York City Neighborhoods on innovative ways to address the protection gap I spoke of, including ways to protect our public infrastructure and reach our most vulnerable populations. We're going to conclude with what I promise will be a very lively panel discussion, bringing our speakers and their diverse perspectives together. We hope what you hear from Theodora, Ben, Mike, and Charlie will leave you feeling inspired and hopeful despite the challenges before us. And with that, I think we're ready to kick it off with the recorded remarks from the Senator.
And thank you for inviting me to speak about climate change and what it means for insurance markets. To go back a step, we have been through basically 3 stages of the climate debate. Stage 1 was the science. And God bless them, the scientists got it right. Even the ones paid by Exxon got it right. And their warnings were loud and clear and simple and plain and true. Then we moved into the stage of politics about climate, where we in politics were supposed to listen to what the scientists had said and take the necessary steps to avoid the predicted consequences. Well, politics catastrophically failed, precisely because of massive corporate influence by the fossil fuel industry, supercharged by the Citizens United decision that not only let them spend unlimited political money, but let them spend it anonymously from behind screens and front groups. So we now enter stage 3, which is the era of consequences, when all the stuff that the scientists warned us about and the politicians failed to prevent start to happen. And the place where it's most noticeable that they're starting to happen is in the insurance industry. Because when the fossil fuel industry has the business model to lie about the future and pretend that everything's going to be okay if they keep polluting, the insurance industry needs to tell the truth about the future. Its entire business model is based on correctly predicting the actuarial risk of future events happening. And with the weather in upheaval because of climate change, they're having real trouble doing that. And that's where you're starting to see insurance markets melt down. So let's start with how this cascades through different markets. Obviously, the insurance market is immediately affected if a property becomes uninsurable or if the cost of insuring it becomes so great that the present value of that carrying cost is greater than the value of the property itself, then the property value goes to nothing, and it's a huge economic loss. And it cascades out, because when you can't get insurance on that particular piece of property, then nobody can get a mortgage on that piece of property either, because the mortgage needs insurance. And if you can't get a mortgage on your property, unless you're a Palm Beach billionaire who's selling to another Palm Beach billionaire and it's all being done in cash, you're stuck. If you're a plumber who lives in a development outside of Orlando and you bought your house with a mortgage, and to sell it and recoup its value, you're going to need to sell it to somebody who can get a mortgage on it, you just got really stuck. So the mortgage markets then crash because the insurance markets have crashed. And with the mortgage markets crashing, the next thing that happens is that property values crash. And the property value crash just from the coastal property values risk has been predicted by the chief economist for Freddie Mac, not a green guy, a mortgage guy from the big mortgage company, Freddie Mac, has predicted that this cascade from insurance failure to mortgage failure to property values crash then washes out into the general economy in the same way that the 2008 mortgage meltdown did. In fact, that's his comparison with what happens, and has a similar effect nationally in terms of economic recession. Now, since he made that prediction, another huge insurance risk has rapidly come to the fore, and that is wildfire risk. So now we have double the chance of that insurance cascade happening, leading to national recession. First, from coastal property values crash, and then also from wildfire adjacent property values crash. So that's where we are. And it's not just me saying it. As I mentioned, this was the chief economist for Freddie Mac who laid out the cascade. And just 2 weeks ago, the chair of the Federal Reserve came to the Senate Banking Committee, and he testified that in 10 to 15 years, there will be regions of the United States where you can no longer get mortgages. Now, 10 to 15 years out, if that's the case, markets will have started to move a good deal sooner, predicting that eventuality. So the insurance risk is already upon us. You see it in Florida happening in real life. I'll come back to that in a minute. The mortgage risk has been warned of by the Fed chair as well as the chief economist of Freddie Mac. We have a recent report out from the international, what's called Financial Stability Board. It's the technical board that warns the international banking system of risks to its solvency and steps that needed to be taken to protect the solvency of the international banking system. And their report was on precisely this cascade, that as insurance becomes unavailable and as mortgages become available, taking that revenue stream away from banks and reducing property values so that the loan to value ratio of banks, which determines their solvency, falls along with the property values. Particularly regionally based banks could have very significant solvency issues and need to be prepared. And in addition to the chief economist of Freddie Mac, the Fed chair, the Financial Stability Board, a very conservative international publication, The Economist magazine, devoted its April issue, the cover story, the threat to what it called the world's largest asset class is having its foundations shaken by the risks from climate change, and predicting that the hit to global real estate markets could amount to $25 trillion. So very responsible people who are not enviros, who are looking at this as a market danger, are warning over and over again of what's coming. So we're not seeing a great deal of this in New England yet. We're seeing sporadic places where non-renewals are up. That's where the insurance company says to the client, you're fired. Thanks for all your business over the years, but we're not going to cover you any longer. Prices are up. And in some cases, people have to shift around among insurers as the market becomes more difficult. Ernie Shigalian has been a witness of mine in the budget committee, and he has testified that he's never seen anything like this and that it's not going in a good direction. And if you want to know what direction it's going, the place to look is Florida, which is first and worst. In Florida, all of the major insurance companies have pulled out. Pop-up insurers have emerged, of which maybe 15 have already gone bankrupt. The state has had to build a state insurance company in order to provide coverage because there aren't enough companies that are willing to provide it. We've examined that entity, and it does not look like it's able to survive some of the predicted risks that Florida is facing from hurricanes and other such storms. In the meantime, Florida also carries the burden for the claims of the pop-up insurance companies that went bust. So that's on Florida's books as well. Florida's storm liability is now greater than its entire state debt. So there are real troubles down there. And if you go back to 2008, you'll remember that rating agencies and the failure of rating agencies had a big role to play. Well, watch out for an entity called Demotech, which is now providing ratings to the Florida insurance companies. The ratings allow the insurance to qualify so that the mortgage that the insurance protects can be sold to Freddie Mac and to Fannie Mae. So it's very important to the banking ecosystem that these ratings be legit. Well, a dozen companies rated by Demotech have already gone bust. A full 20% of the companies that it has rated have gone bust. So a very close look at Demotech is in order. But the overall conclusion here is that the Florida insurance market is trembling and ready to fall. As Ernest Hemingway said about going broke, it happens gradually and then all at once. Well, in Florida, they're well into gradually, and all at once could happen anytime. And that is a preview of coming attractions for us in Rhode Island and New England. So the conclusion here is it's darn well past time to get serious about climate change and try to undo and mitigate as many of the effects as we can that are driving these changes that are shaking the insurance market and rattling the foundations of the international real estate market. It's time to get serious about this. Thanks so much for having me in. I wish you all the best.
I'm Ellen Douglas of AECOM, formerly of UMass Boston. Go Beacons. And I'm here to introduce our cast of very interesting speakers. That was a very sobering summary of our current situation. And now we have some speakers here who are working within that current situation to find really hopeful innovative solutions. So our first speaker is Mr. Charlie Sidoti, who's the executive director of Insure, a nonprofit innovation hub catalyzing novel insurance solutions that address climate change risk. He's worked in the insurance industry for over 35 years, and his experience includes senior leadership roles with P&C insurance carriers and 10 years leading insurance adjacent analytic focus startups. You can read more about Charlie in the agenda, but I'd like to welcome Charlie to talk.
Thank you very much. Thank you. Thank you very much. Thank you for the opportunity to speak. Very exciting to kind of hear the sobering comments of Senator Whitehouse. We're going to talk a little bit about the EBC team asked me to talk just a little bit about insurance kind of 101. To set the stage, we'll go through what the challenge is, what we think Insure kind of our team is kind of promoting as a pathway forward in this challenging environment, and dig deeper a little bit into catalytic capital and why it's important, how it could be achieved, and what success looks like in the end. Just starting with a little bit just about basic risk management and insurance. First of all, just to define risk is the potential for harm. I think everybody knows that, but it is really forward-looking. And what the Senator Whitehouse said, he mentioned the signal, or insurance provides a signal because they are looking forward, and risk is really about kind of what is going to happen in 12 months, 5 years, 10 years, 20 years. And when you look at that, there is, the basic kind of risk management cycle is identify risk, analyze risk, treat risk, which we'll talk a little bit in a second, and then finance any residual risk, and then rinse and repeat. That's the way insurance companies look at it, and that's the way communities should look at it. And I'm going to just step through a few of those. Analyzing risk is the key to all decision making. And there's some very different approaches. There's engineering approaches, and some companies in the insurance industry are very focused on engineering. Factory Mutual is a company that doesn't have actuaries. They have an army of engineers, and they do research, and they look at risk through an engineering lens of what is going to happen. There's also analytic approaches. Actuarial science is an analytic approach that is calculating the future cost of risk based on lots of different models, and they price risk and they make decisions through that lens. I also want to talk about, people don't talk much about kind of market considerations and market position and market factors that people don't normally think about as part of a risk analysis approach are very much part of decision making in the insurance industry. And I just want to give you an example. I worked for a company that was a global company that insured properties all over the world and businesses all over the world. They also insured 50% of the properties on Cape Cod and the islands. Through mergers and acquisitions, they shrunk down to a national US company. And then they further kind of divested and shrunk down to a New England, New York, New Jersey company. Nothing at all changed about the engineering or the analytics, but the half of the business that they wrote on the Cape and Islands just became a different size of the pie chart that they insured. And I worked there, and kind of we made corporate decisions to say, to manage our risk, we need to non-renew 60-70% of the people on the Cape and Islands. And that is a tough message to kind of have conversations with policyholders saying, well, we're non-renewing you because we made some corporate decisions, and we're just going to non-renew. So those type of kind of corporate market capital decisions are very much part of kind of the risk analysis that insurance companies do. And as you're doing analysis, anybody's doing analysis, whether it's the insurance industry or a community or an individual, there's really only 4 treatments that you can apply. You can somehow avoid the risk and maybe move or stop doing a certain piece of business. You can invest in mitigation to bend the cost curve, to say, hey, we're gonna invest in a number of things, nature-based solutions, kind of home hardening. There's a lot of things you can do to lower the risk. You can also accept risk, which kind of says, okay, we're gonna take the risk and figure out how to finance it. Or you can transfer risk to somebody else and pay a cost to do that. The interesting kind of dynamic between insurance companies, they make a lot of decisions across that whole kind of spectrum of treatments. But the main one is, what do they accept and what don't they accept? You hear a lot, there's a lot of corporate discussions when you're at a company about what's our appetite. So that is like, what states are we going to operate in, at what price, and there's decisions. The current situation that the senator talked about so eloquently is a lot of those decisions are exiting, which are creating large and growing protection gaps. And those protection gaps are the uninsured, the underinsured, and those are de facto decisions for communities and the individuals and enterprises in those communities that they have no choice but accepting the risk. They have the risk. The risk is on the communities, because when it flows through it is going to land on the communities. So it's an important thing to understand where the risk lands. And then when you think about residual risk, there's a lot of different ways to finance risk, and we can go into some of them, but there's two kind of buckets of financing, pre-loss. So you can decide, okay, we're gonna, based on all the models, do our best guess estimate. These are what the losses are gonna come through based on some sort of frequency and severity analysis. The losses are gonna be these. How do we fund it? And you could set up reserves, you could buy insurance, which requires reserves to back it. And there's also post-loss financing, which is figuring it out after the fact. And figuring out after the fact works really good for predictable, kind of low value losses that, are within the scope of whatever the capital structure is of whoever's making the decision, that they can be funded. And there's a lot of different ways to do post-loss funding. There's just paying it out of current assets. There's debt, like, okay, we're just going to borrow money when this happens. Most losses, and actually an important point is the FAIR plans are often, and they're all different, but the FAIR plans are often have a post-loss component to them. The assessments, I got recently interviewed about California, and it's like, well, the bailout. And it was like, well, no, that's the system that if the losses exceed the ability of the FAIR plan to pay, there is a mechanism to assess people after the fact. So that is a kind of there is some reserves there, but there is a post-loss financing component to it. And post-loss financing is really not a super efficient way to operate. And especially, communities that are accepting risks and they don't really even kind of know their complete kind of like, what is the loss? What is the total cost of the loss, and who exactly does it land on? It's really challenging. And a little bit is like, well, I just hope it doesn't happen and we'll figure it out later. That's probably not a good practice. So you don't need to read all this, but I think one of the key points that we like to highlight is that this is the system of financing losses, including insurance, is broken. It is really broken, and it needs to be reimagined. And to reimagine the whole system requires behavior change and collaboration and reimagining a system across all the different stakeholders. So, consumers need to kind of think about like, okay, where do they live and how do they build? That affects policyholders. The insurance industry needs to start thinking longer term and say like, if we keep kind of exiting markets, the risk isn't that they're going to lose money because they know how to underwrite the risk and price the risk. The risk is that they will be irrelevant. Like if they're not insuring anything, they're going to be irrelevant. So we really think that the system needs to be reimagined, and we are trying to think about how to align incentives, get people working together, and reimagine a system that really works for everybody. And again, you don't need to read all the boxes here, but capital is critically important to kind of this whole system. And there needs to be catalytic capital that will lean in and drive innovation in ways, and innovation in both mitigation. How can it support mitigation? Because we need to bend the cost curve down, but we also need to build new methods, new ways of financing risk. So innovation in insurance and also other types of risk financing mechanisms. And one of the things that, and I come out of insurance, but over the last couple of years, one of the things that I realized was that there is this whole world of community development banks and community development financial institutions, which are locally connected in a very big way. So they are connected to communities. They are often mission driven. So they are trying to work with the communities that they know extremely well to solve economic development challenges, housing challenges, real challenges of the community. And they are putting capital at risk, not in a kind of philanthropic way. They are running businesses and they need to underwrite, and they do underwrite, but they are close to the community and they are taking risks that maybe some of the other larger banks don't do because they know the communities better. And what we believe is that this model could provide a path forward for community development reinsurance institutions. The capital structure of the industry is dominated by huge global companies. And I know Ben McNeil's here somewhere with Swiss Re, which is a great company and they're doing great work. But it is very, very challenging for a global company with hundreds of billions or whatever, 40, $50 billion worth of kind of revenue operating globally to be that close connected to the communities and engage in ways that is deploying capital in that kind of catalytic way that we think is necessary. We think the development of community development reinsurance will foster innovation in new products and services and solutions that could be then adopted and further backed and crowd in capital from the big companies. It could be the catalyst for innovation in a number of ways. And getting back to, we think the whole system is broken. We love products like parametric and microinsurance, but there is no silver bullet. We think all parts of the system need to be innovated and innovated rapidly and innovated now. And that means, the capital stacks that I talked a little bit about. It means the products that are being offered, like parametric and microinsurance. It also means distribution. We think that kind of employer group insurance provides a very interesting model for community-based insurance. And I know New York Neighborhoods is going to be on the panel. They've done some interesting pilots, but there needs to be a lot more pilots on kind of leveraging the buying power to intervene in insurance markets to capture value of the local investments that are being put into mitigation. And one of the things, the insurance innovation generally comes from, if you look at this kind of diagram over on, I guess it's my left, is, innovation comes from the industry and is pushed to communities as, hey, these are some products and services that we came up with. And that is great. That more of that needs to happen. The industry needs to invest and others need to invest more in R&D. But we think one of the biggest opportunity is going directly to the communities. And instead of saying these are products we think the communities will want and need, is to start with communities and understand, like, what is the problem here? Where are you investing in mitigation? How can we capture the value of that investment in mitigation quickly and fully in current insurance markets? That will provide a kind of ROI to unlock more capital to invest in mitigation. And so we think kind of community focused, and I think, Kyle, this is one of your questions later. Sorry to kind of jump ahead on that. We are in kind of early stages. We are running a number of pilot projects at all kind of locally kind of driven. We are working on with a community of 2,000 very low income homeowners in Virginia who have been flooded twice, riverine, and this is in kind of Western Virginia, Southwestern Virginia, to kind of understand, what can they do with their wastewater treatment, And can they do some sort of potential community embedded insurance? And what we always do is we go in and we say, let's try to calculate a baseline total cost of risk, which is the cost of investments in mitigation, plus the costs of any risk transfer, plus any retained loss costs and any response and recovery costs, and then start doing scenarios that say, if we change these things, how does it change both the number, but also who the costs land on? And that is our basic model across all of these programs. And what we were trying to also do along the way is co-create some technology that will help communities make decisions by better understanding their total cost of risk. So they're kind of consulting engagements right now. They're planning projects, but we're trying to get to implementation of some of the recommendations. We're also doing a project following that same methodology in California sponsored by the Robert Wood Johnson Foundation, and working with California Department of Insurance and CAL FIRE and 5 or 6 FireWise communities to identify the value of the home hardening investments and defensible space investments that they are making related to wildfire in insurance markets. And then in the city of Honolulu, we were working with a economic development firm that is helping the city of Honolulu do their resilience plan. And everything I've been talking about is how do you integrate insurability planning into economic development planning and resilience planning? Because of some of those factors I talked about earlier, insurability it's related to physical resilience, but it is different from physical resilience because it does depend on some of these market-based factors and the ability to quantify risk precisely. So insurability planning integrated at a local level, which requires a lot of capacity building for local leaders. And then the final project, I think Neil is here somewhere, but hey, Neil. We're working with the city of Salem, who came up with this idea to do home resilience audits related to flood and kind of modeled after the energy audits. But to say, how can we provide individuals, advice on how to make their particular kind of asset more resilient, and how do we, and so we are trying to incorporate some resilience planning, insurability planning along with that. And with that, I'll kind of open it up for questions, but just, what does success look like? We want to flip it from a kind of reactive thing where people are kind of all the different stakeholders I showed are working on their own projects and priorities to a more collaborative approach where we create a positive cycle of investments in mitigation, are captured quickly in the markets, which allows more investments in mitigation, which kind of reverses the cycle I think we're in right now. So thank you very much.
All right, thank you so much, Charlie. I also want to, before diving into questions here for your talk, just a quick thanks on the 101 primer. This is a very dense topic, especially even for folks coming from the engineering and planning industry, where we're recognizing, the speed of adaptation mitigation activities that we're doing is in need of innovation in the risk transfer space. So I first want to thank you on, agreeing to also give a little bit of a insurance 101 here. So with that, any questions for Charlie?
Kyle's going to get to you first. Can you please introduce yourself as you ask your question?
Good morning, Adam Schlosser. I work at MIT's Center for Sustainability Science and Strategy. I was really compelled by your talk. It's very, very exciting. I agree with the partnership and the collaborative nature of what needs to be done to solve this. What I'd like to do for my question is to circle back on what Senator Whitehouse said. So I think it's wonderful that he thinks that scientists did it right. And I would agree with him as a climate scientist, we did it right. But what I will say this is when thinking about moving forward on thinking about resilience of physical risks, and I might even argue even financial risks, the science still needs to be there, particularly at the community level and the granular level. And what I felt was not to nitpick at your slides, but what I felt was missing in your slides was where is the science? Where does it need to be? Where's the value proposition, particularly in the financial perspective of all this? Where would you see that going right now?
Yep. Great question. Thank you very much. I think there's two things. There's a lot of existing science that is available to insurers and other very sophisticated, like large corporations that are, modeling their portfolios of assets and making decisions based on those. Those are largely not available to communities. So I think step one is like, how do we get existing science down to communities in a format where it can be consumed? And we have this kind of model of, the industry uses this number called the average annual loss. And what we say is like, this is one number. If you said the uninsured average annual loss based on models, and I'll talk about like where models need to go in a second, but that is a concept where if you're a decision maker at a community, you don't need to be an actuary or kind of a scientist to say, hey, if I invest in, mitigation, it's going to drive that number down because we're lowering the loss. But if I also invest in risk transfer, it's also going to drive that number down because it's going to transfer risk off of the backs of the municipality and the people in, and then you can optimize investments. So that is one thing about modeling that we are trying to present a number to community leaders to say, this is the number we want to focus on, and then we want to optimize our investments across it. But you're right. A lot of R&D and modeling, and I know Mike Beck's going to be talking, a lot more needs to be done because the modeling world is very good at kind of large, broad-based models that cover like, North America or Northeast United States, and they miss all these kind of hyperlocal investments in mitigation. And it's like, well, how do we quantify those? We need to quantify those. We need new models. We need more models. We think it's a multi-model world going forward, that people aren't kind of just buying one big model that does all hazards and all geographies. They're plugging in lots of different models. And then what we need to do is build kind of these middleware things that can bring the data to decision makers who aren't super sophisticated at kind of modeling.
Kyle, I think we have a question from virtual attendees that my colleague Jackson is going to read out for everyone.
I'm going to do my best. So this question comes from Esteban. How do you recognize resiliency, aka lower risk by property design? Everyone in an area seems to fall in the same risk category, good and bad projects together. How are you dealing with the fact that building codes do not account for climate change?
It is a great question, and I think it ties back a little bit to the last answer. We have models. There are lots of models. They can provide some insight into that. We need more models and different models and more precise models. And we think we need the cost accounting around those at a hyper local level to inform kind of the building codes and all the decisions that are made. There's a risk financing is often done kind of out here, but the mechanisms of mitigation and even the impacts of the financing are hyper local. It's local communities that control land use, they control infrastructure, they largely control building codes. Like the data should be where the decisions are being made that affect the data. It's often disconnected, which is that misalignment of incentives that I talked about. And I think the more we can align incentives, align kind of cost accounting and to the decision makers at the community level is critical.
Excellent. So I think we have time for one more in the room question here. Over here, Julie.
Julie, can you introduce yourself?
I'm Julie. I'm the City of Cambridge climate chief. And, I'm listening to this and this seems like a better idea than what we have now. But then you think of LA or Paradise, California, and unlike something like theft, climate risks, everybody has that giant climate risk. And, in something like Asheville floods, it doesn't really matter at a property level what you've done when the whole street gets wiped out. And so the question is is this also an interim strategy before where you really have to move away from harm's way as much as you can? You don't have River Valley communities anymore because the end game.
Great question. And there's not a yes and no answer to that. One of the things that we believe is, like everything I talked about, if you understand the total cost of risk and who it lands on, that doesn't mean that it's easy decisions. What it's going to highlight is some really hard decisions and there's no question that it's going to lead to some very difficult decisions, including things like there's no way we can mitigate this. And maybe people should not be living here. But making those decisions without the kind of local understanding of how the loss costs flow through and what the mitigation costs would be, it is just then a political process of oh, well, you need to move and you need to move, and it probably will land on the most vulnerable kind of economic kind of constituents without a transparent kind of way to calculate that. So we think there's hard decisions ahead for sure, but we want to make them kind of with the science kind of behind it.
Excellent. Well, Charlie will be hanging around. He'll be part of the panel later, and hold on to questions. He'll be around later as well.
Now I'd like to introduce Professor Michael Beck. There you are. Okay. He is the director of the Center on Coastal Climate Resilience and AXA Chair in Coastal Resilience in the University of California, Santa Cruz. Came all the way here to talk to us today. Mike aims to reduce risks to people, property, and nature in his work across science, policy, and practice. He served 20 years as lead marine scientist at the Nature Conservancy. He's advised many government agencies, and he's also a Fulbright scholar. So take it away, Michael.
All right. Good morning, everybody. It's a real pleasure to be here. Awesome day outside. I have appreciated the invite and the opportunity to speak with you. I also gave a lecture yesterday as part of the Sustainable Solutions series at UMass. A few of the slides that you guys will hear if you were there yesterday, some of those will be the same. You're welcome. Or take a rest, in the meantime. So part of my job here is to talk a little bit about climate risk, to talk a little bit about the kind of 101 on nature-based solutions. I'll do that, and then we'll talk a little bit about some of the what I see happening now and some recommendations for the future in the intersection between nature and insurance. Okay, in the first instance, the risks here are real and they're rising. Climate change is here. This is no longer a problem of the future. I provide just a couple of examples of that you see before you here. The movie that's playing is from the extreme wave event in Santa Cruz about 2 months ago. I was on the shore for this, and this is one of my favorite wharf restaurants washing into the mouth of the San Lorenzo River. So really extreme waves, not just in height, around 25 feet high, but also a wave period of around 25 seconds. And most people think about wave height as the problem, but it's really the period, which is the volume of water. California wildfires, again, very recently. And then the lowest photo is after Hurricane Helene, taken by my daughter, who now lives in St. Pete and happens to be an evacuation expert, even more than I am. And that's not something that a dad wants to say. Okay, this is not just a coastal elite problem. This is from a recent Treasury report looking at increases in claim frequencies. And you can see that that is in particular right up the heartland. And where you see increases in claims, you are going to soon see increases in the cost of insurance. So again, this is very much a nationwide problem. Okay, I want to talk a little bit about nature-based solutions and the intersection between nature and insurance. What we do in the Center for Coastal Climate Resilience is we assess coastal risks. We value the benefits of nature, like wetlands and reefs, and I'm talking about marshes, oyster reefs, coral reefs, rocky reefs off the coast here, and mangroves. We value the benefits of wetlands and reefs for reducing that risk. And then by being able to value those benefits, we look for incentives to invest in their conservation and restoration for that risk reduction. And those incentives span the gamut from insurance incentives to how we spend our infrastructure money, our disaster recovery money, and the like. So that's in the bulk what we do. I have spared you, again, you're welcome, all of the modeling effort that it takes to do this kind of work and reduce that to a cartoon. So the cartoon says you do a whole bunch of modeling to measure waves and water level offshore. You model how those waves and waters change as they get near shore. You can also include measures like habitat and ask how habitats like wetlands and reef change that flooding. Look at the differences in flooding. So when you remove those systems like mangroves, like wetlands, then you increase the amount of flooding, and then you can look at the consequences of that economically and socially. We do the kind of modeling that is common throughout the engineering and insurance sector. This is kind of the basis of all coastal flood modeling. And this, again, is just a nice little flume video that gives you kind of some idea of what we're talking about. Again, this is part of the 101. So basically, in this instance, you see a mangrove reducing waves. They also reduce surge. Our habitats like oyster reefs and rocky reefs offshore, they primarily act by breaking waves. So that's the benefit that they provide. All right, so that's the fun stuff there. What we then do is assess the consequence. So I'm going to show you some of the numbers, some of the values coming out of these analyses. In 2017, we had hurricanes Irma and Maria, in particular affecting the Caribbean and Florida. And as part of that, those storms didn't just damage gray infrastructure, they damaged our natural infrastructure. That is the reefs offshore in both Puerto Rico, US Virgin Islands, and Florida. And that has real consequences for flood risk. And that's what we're showing here. So after those storms, NOAA measured the damages to reefs. That's the blue. So it knocked the height down of those natural barriers. We then assess with USGS, what does that mean in terms of increases in risk? And that's the colored bars on top of the white bars. So the white bars that you see here was the risk before the reefs were damaged in the 100-year floodplain. So that's the economic risks in those areas. With the damage to the reefs, risk increases, and that's the increase in the height of the bars in the yellow, orange, and red. So this is to say that the loss of nature has real consequences to people and property, and we can measure that and we can show the spatial variation in those impacts. Which then also means that we can measure the value of restoring those benefits, those reefs. And so in this case, again, working with USGS, published all of the data is available online through USGS. Recent paper just out in Science Advances on all of our work for Florida and Puerto Rico on this. We examined, so the yellow line here shows potential reef restoration, shallow near shore reef restoration within the existing reef envelope. And then we asked, how much would that reef restoration reduce risks? And that's the blue on top of these white bars. So that's how much reef restoration could reduce economic risk, and we can identify where that benefit would be the greatest. And then based on that, we can do benefit cost analysis using the same tools that the Army Corps, FEMA uses. We can show that there can be really significant benefits to costs for that reef restoration. And we can show where those values are highest throughout coasts of Florida and Puerto Rico. So again, we can value those benefits. We can show they're real. We can show where they're greatest, and they provide real significant benefits. And then we've used this kind of work to be able to change policy and practice. So we've led workshops helping others who are applying for FEMA funds after those hurricanes. So that represents some $100 billion that was available for projects, was only available previously to support the rebuilding of human-made infrastructure, not our national natural infrastructure. That's what we work to change. We develop guidance with our agency partners on how to do reef restoration for risk reduction, and that helped some of the proponents who applied for and successfully for the first time got FEMA money for nature-based restoration. So the restoration of coral reefs off of San Juan. We also worked with the Coral Reef Task Force and some of the territories in the state of Hawaii through executive orders and legislation to get reefs identified as natural infrastructure, making it more available for infrastructure, hazard mitigation, disaster recovery funding. And if you're someone who cares about the conservation and the restoration of these habitats, that's where the real money is. You could talk about the dream of doubling conservation or environment money, and that comes nowhere near close if we could just change the trajectory of 10% of our recovery funding, just by way of example. Okay, so we've used kind of all this, where I've given you some example of how we apply this towards solutions. I'm going to talk just a little bit more, focusing in particular on the intersections with insurance here. All right, so about starting a little more than 10 years ago, working together with Guy Carpenter, Lloyd's Risk Management Solutions, we wanted to ask, what was the value of wetlands for reducing risks during Hurricane Sandy? And so instead of doing this, despite the fact that our models are really very much the same as the industry models, because the industry models are nonetheless taken as truth, we said, well, why don't we work inside of the industry's models and work with our partners to assess and see what they say is the value of wetlands in their models. And what we found using the RMS's model at the time was that wetlands reduce the damages, salt marshes in particular, reduce the damages from Hurricane Sandy by some $625 million. We then also said, looking across a whole wide range of storms, as you typically would in an insurance model, what was the benefit of marshes overall in this region? Some 15% annual average reduction in damages, which should be sufficient for premium reductions. That's the kind of benefit that you would not be surprised to get a premium reduction for if you were doing salt marsh conservation or restoration. I wish I could tell you that was enough. It wasn't. There are a variety of reasons. We'll get into some of that in the discussion, I hope. But it wasn't like there was using the industry's own models and some very sensible results and things that if you were actually out, and I talked to a number of folks yesterday who were like, yeah, I saw those differences out in the field afterwards. Despite all this very sensible evidence and inside the industry's model, not a lot of change yet. Let's hope. We've also worked together, and that included with Swiss Re and when I was with the Nature Conservancy to develop some innovative insurance approaches, insuring the coral reefs, in this case in Mexico, just a little bit south of Cancun, using a parametric product such that if there was a storm of a certain intensity over 100 knots within this area, there would be a payout so that there could be quick actions to restore the reefs. And this is a place where a parametric tool has a lot of benefits because a quick payout means that you can get the community to work at a time when they need work. The real damage of storms to reefs is knocking off the big coral heads, so they're rolling around in the lagoon, still alive in many instances. So if you can either get them back glued on the reef or into nurseries, you can keep them growing. And there's also a lot of trash on the reefs after storm events. The flotsam and jetsam of our coastal lives, refrigerators to fishing nets, that if you remove those, don't keep causing damage. So this was a policy that did pay out after Hurricane Delta and has been growing. A number of more reefs insured along the Mesoamerican reef. Small, but growing. We've also been working together with Guy Carpenter, Cat Risk, Munich Re, AXA Climate to be able to look for other opportunities in other habitats like mangroves in the Philippines. And so this isn't just what's the benefits of risk reduction. We actually went all the way through to premium pricing and ask, how much prices could be reduced through mangrove conservation. We looked first Philippines wide, and again, that includes a lot of areas that don't necessarily have mangroves. So if you look at a Philippine-wide, premium pricing, not a lot of change or benefit there. Some benefits at a regional level. So the Visayas is a large region in the Philippines. Again, some areas with and without mangroves. But if you look at places like Sagay City, then you actually do find opportunities where mangrove and mangrove conservation and restoration should offer significant premium reduction, particularly for moderate scale events. Okay, one of the things that we haven't looked at before previously that I'm aware of in general here, looking at the benefits of nature, most of what you've heard in terms of evidence out there looks at what's the value of these habitats for directly reducing damages from storms. In this case, we're asking, how do storms and the perceptions of storm risk and the benefits of potential benefits, perceived benefits of these habitats affect home pricing? So here we're looking at Zillow home prices after major hurricane seasons, but not after hurricane seasons that damaged properties in this area of Florida. We're looking at storms that were passing by elsewhere in the Gulf, but it was a really significant storm season. And then we look at home prices a couple of years after. And what we find is that homes that were near mangroves sold for higher prices. And again, this is not because of damage. This is because the perception of risk and the perception of benefits sold for higher prices and with less variability in that pricing. This benefit could be enormous and opens up a variety of investment opportunities, we believe. So some real opportunity there. I also want to say one very important thing. We talked a little bit about risk models, and I think it is really important to take these risk models out of the black boxes that they're in. And there's a variety of ways to do that. You don't have to, everybody doesn't have to see all of the guts of the model, but you can visualize those. And that's what we've been doing. We're taking model results and then being able to put them into game engines so that we can look at the results. This also allows us to be able to compare effects of habitat loss and climate change. And what's not often recognized here, people are kind of somewhat aware of the risks of climate change, but that will happen primarily in future decades. Some of that is happening now. It will really grow in future decades. What we show in these models here is that in a number of places, habitat loss now has the same effects on risk as increases in sea levels in the future. We've compiled some of our key recommendations in a number of different places. Here's one report where you can find more information about what we think the industry should be doing in the intersection with nature. And then just as a presage for some of our discussions, I wanted to put some of these points down. I consider myself a friend of the industry, work very closely with the industry. You might imagine that that's a little preface to be a little hard on my friends, is the way that I would view it. I would say we've been working for a long time with the industry on trying to work on direct benefits and products. I would say the take-up of that has been limited, and I'm being super nice to my friends. But I think the indirect benefits to nature are actually huge. And that's one of the things that I do want to talk to with folks about. I mean, right now, we've seen both federal and even in California, state governments essentially getting out of the business of managing some of where we're developing and redeveloping. So that means that the availability and the costs of insurance may be the major drivers of where we're going to be developing, and development is the single greatest impact to nature. If you want to find out more, you can check out my AXA Masterclass. I realized when I put this up, I'm wearing the same damn jacket that I did then, as though I only have one, and that was a little bit ago. Thank you.
Awesome. Well, that was really fascinating. I think in general, the topics here that you're covering, something really to be excited about, apply beyond. Obviously, you mentioned reefs, mangroves. We don't have those here in New England, but we have plenty. You look out the windows, you see the harbor islands, you see our diminishing salt marsh resources and coastal wetlands. So there's a great amount of applicability to what Dr. Beck is talking about here.
Yeah, I just want to reinforce that. Yes, it's true that the story arc is a little bit easier to tell in full across mangroves and reefs, but everything about those wetlands and reefs applies exactly to the work that we're doing in California on rocky reefs and here, and same for salt marshes. And we have other evidence and visualizations on our site about that.
Excellent. Any questions? Can we start over here?
Nice to see you, Mike. Steve Long with the Nature Conservancy. Been working on adaptation policy for nearly 20 years in Massachusetts. What would you say are the major barriers to the adoption and mainstreaming of nature-based solutions?
So if we're talking specifically in insurance, I will give you first the answer that they give me, because I've asked them that a whole bunch of times. And what my friends say is client demand. And I do believe that some of that is, if clients aren't asking for it, then there's not a lot of incentive for the industry change. So I do think it is incumbent upon us who care about these things that we should be pushing some of their clients, whether it's the hotels, whether it's FEMA as a buyer of insurance, among others. That is something that we could do that would help push this along. Okay. If I might say the other answer is laziness. That is, if you've got a good thing going, why change that up? And it takes time and effort. Why do that if you don't need to? That's very short answers to a very complex problem. So, take it with a grain of salt.
Jackson, do we have a virtual question?
Yes, we do. Take off my headphones so I don't hear myself twice. Chad Sumner from Sumco Eco Contracting. Hi, Chad. All well and good to know the value of nature-based solutions, but implementing them often runs at odds with regulatory constraints. For example, nearshore reefs, oyster castles, and even salt marshes, and sills run afoul of, quote, resource conversion, end quote, impacts to intertidal habitat, subtidal habitat, etc., at least in the Commonwealth of Massachusetts. How can we reconcile this in time to provide protections?
Yes. Inane is a word to describe it in part. Those of you who were at the seminar yesterday, I got up on my soapbox for a while, so I'm only going to get up on it very, very shortly here, which is to say, most of the time, the actual implementation of projects, and I didn't have time today to talk about many that we have been involved in, and many of the challenges that we've faced in permitting. The thing standing in the way is not the benefits, is not even the engineering community. It is often environmental managers and environmentalists who are standing in the way most often in permitting projects. I wish I could tell you I understand, because I actually, these are my people, in many respects. We basically have to wait, for example, in the case of oysters, till we've got none left before we're willing to try almost anything in the resurrection. And I can absolutely assure you this is the case for coral reefs, having been denied a couple of different extraordinarily sensible permits for protecting people, property, and growing corals.
I think I heard a question over here. Or can we go over here? Sorry.
Yes. Hi, Noah Slovin with SLR Consulting. The insuring reefs piece I found to be very interesting. I think a challenge also with kind of promoting nature-based solutions, or like you're talking about with a municipality, is if you have hard infrastructure, you know who's in charge of it, who's responsible, who you complain to if it's not kept up. Whereas if you're having an offshore reef, who do you sue if it doesn't work? So from the community, not to say that that's the way it should be, but I can imagine that the kind of responsibility is less clear. And I wonder if in that specific case, there was a mechanism set up for who's responsible, or if you have any other thoughts on that.
Well, I'd say the main thing that we've been trying to do and trying to make the case for, and I believe is 100% possible, is that there should be a level playing field here. How we treat gray infrastructure is exactly the way that we ought to treat natural infrastructure, is the shortest way of answering the question here. We've tried to do that in the benefit analysis, in the BCAs, in the same thing about design and the like. And so in the same way that all kinds of offshore structures for coastal protection and otherwise are built and responsibility is maintained by municipalities or whoever, military bases in some cases, that's how it ought to be handled for these hybrid infrastructures.
All right, so I think we have time for one more, and we do have a virtual one.
This question comes from Susie Moser. In the assessment of the benefits to home prices due to the perception of the benefits of mangroves and/or wetlands, how did you discern that from other potential influences on home prices?
Hey, Susie. Yeah, simple question there. No, I'm not showing you all the component parts of the regression analysis that my economist friends did, but I am happy to show you sometime.
All right, well, if we didn't get to your question, please hold for the panel, and thanks again.
Hello, everybody again. I am really happy to introduce Ben McNeil, who has spent his career focusing on public sector disaster resilience and risk management. He's currently working at Swiss Re's public sector solutions team, helping municipalities in North America define, develop, and manage their risk transfer strategies. He previously worked for the city of Boston right here for 9 years, serving most recently as the city's risk finance manager. Ben also serves as a petty officer second class for the U.S. Coast Guard Reserves out of Station Boston. So Ben, where did you go? Right. Oh, welcome, Ben.
Got my clicker, good to go. Yes, Ben McNeil, my name. Please don't call me Benjamin unless I'm in trouble. Thank you all for having me today. It's an honor to be here. Thank you to our host, the co-chair and the steering committee for putting on this event. I also want to give a shout out to my brother. It is his birthday today. He is Sam. He is a reporter for the Associated Press in Jerusalem. And so much like we acknowledge our public servants this morning, just want to acknowledge those. I think we have media members that are here or online and the role that they do in our country and around the world. Nope. There we go. So yeah, my name is Ben McNeil. I work for Swiss Re and our public sector solutions team. Swiss Re is a leading provider of reinsurance, insurance, and other insurance-based forms of risk transfer. Our global client base consists of insurance companies, mid to large-sized corporations, and public sector clients. Just to give a brief summary of reinsurance, everyone knows what reinsurance is, right? Reinsurance is insurance for insurers. So we essentially write policies on behalf of insurers. So those are typically, large insurance companies, but we also provide reinsurance to public providers of insurance as well. I think FEMA, large states, fair plans, things of that nature. I work for the public sector solutions team. We were created as a dedicated function within Swiss Re to partner with governments, international institutions, and the broader public sector ecosystem. We specialize in partnering with public entities to develop tailored solutions that focus on 5 critical areas: strengthening disaster resilience, facilitating economic growth, protecting public assets, building resilient infrastructure, and promoting public health. Can I get a different, maybe if I click here? That work? Great. Come on. Maybe in the back, advance. There we go. So today's talk, I want to focus on, I've got 3 things I want to go over. So one is just going to be public sector risk and the role of insurance. We're going to talk a little bit about insurance solutions, so how we can use risk transfer to sort of solve some of our challenges, and then talk about some of these challenges and opportunities that we have in the public sector. So first, I want to start with a building that looks very familiar to all of you, and it's where I spent prior to last March the first 10 years of my career. So this is with, it's the clicker, blame the clicker. So I was with the city of Boston for 10 years prior to joining Swiss Re. I started at the Boston, don't use that one. I started at the Boston Public Health Commission, managing our Medical Intelligence Center and Healthcare Preparedness Coalition. And then I transitioned to the director of our Emergency Operations Center starting in the winter of 2020. Great timing. I will save that story for another day. It's nice to see Joe Christo. We spent a lot of stressful hours together on different initiatives. And I'd spent my career, both academic and professional, working on preparedness and the response side in emergency management, but was always interested and often working on issues related to mitigation and recovery. Following a large event, what enables a community to recover stronger, more efficient, and more equitably? How can we recover in a way that makes us more resilient to future disasters? What are the investments we can make now that reduce our risk and mitigate the impacts of a natural disaster? The part of the recovery I was most involved with was with our budget office during our applications for FEMA public assistance. There we go. Where the budget office was, their lead role was for applying for federal recovery funding after a federally declared disaster. We would help compile the total amount of costs that the city incurred that were eligible for the program, which, while tedious, cumbersome, and often slow, payouts could happen typically about a year later. The end result was quite juicy. The feds could provide 75% cost share for most emergencies. And even for COVID-19, the cost share was 100%. So a very incentivized program to participate in. These funds are intended to help municipalities recover from the damages and costs incurred, and are also intended to support building back better if those reimbursed funds were due to damaged property or infrastructure. So post-pandemic, and after coming out of parental leave, I took on the role of risk finance manager in the budget office, which is where I want to focus next. What does a risk finance manager do? So for the sake of today's presentation, I'll talk a little bit, or also use the role or the name risk manager. These titles can be synonymous, but also their functions and who or what department is responsible for their various functions can depend based on the municipality. So ultimately, risk managers are responsible for determining how their municipality will manage their financial risk exposures. And based on that analysis combined with an understanding of sort of your municipal sort of fiscal health, what risk management strategies would we or the risk manager pursue? How do we pay for losses, both that protect and prepare for our liabilities? From a public works vehicle that is damaged in a snowstorm, to someone who slips and falls on city property, to larger exposure events such as a pipe burst or failure of mechanical equipment that results in significant property damage, or a large nor'easter damaging municipal infrastructure and property. Yes, those are all things that I had to deal with at the city of Boston. This slide gives you a little bit of a sense of the different costs public entities can be exposed to. But for the purposes of this forum today and the focus, I want to talk about the impacts of disasters and other large-scale events on municipalities. So in addition to sort of managing these direct costs, we have to think about the longer-term costs associated with these exposures. Some of these have been brought up today, but specific to disasters, this could include the depreciation of property values that can lead to lower tax revenue, impacts to other revenue sources, and impacts to municipal credit ratings. So what do we do at the City of Boston? So when we were coming up with our risk management strategy, we had to take our hazard analysis and then also combine that with an understanding of our fiscal health. So as you all are well aware, the city has a AAA bond rating, a healthy number of reserves, and ultimately that led us to primarily self-insure for most of our exposures. So what is self-insurance? Self-insurance is essentially taking on those costs and exposures directly, budgeting for them, combined with very sort of focused loss control, risk management to sort of manage each of those exposures and ensure we have the funds available to cover some of those losses. We also decided, though, that we wanted to purchase some risk transfer for events or for exposures that are either relatively affordable to insure or unaffordable to not insure. So primarily that resulted in us purchasing a large property insurance program. So the city has a little over, or at least when I was there, about $7 billion of total insurable value. We purchased $300 million of an all hazard risk policy. And these limits were based on sort of a probable maximum loss scenario that our broker helped us understand, and also was based on sort of what's available in the market and the price of that insurance at the time. The other part of our risk management strategy or financial risk management strategy was reliance upon the federal government. I talked earlier about FEMA public assistance, but they were a key part of our sort of analysis and thinking that, you know, if we have a large enough event, we don't need to buy $7 billion of insurance. Kind of hard to think of an event that would cost $7 billion to the city of Boston, but we knew above the limits that we were buying for property that we could hopefully, in today's context, not quite so sure, rely upon the federal government to help with that recovery effort. I provide this example to give you a sense of the process that all municipalities are going through as they develop their risk management strategy, and how risk transfer sort of fits into the overall structure of that program. And as I mentioned earlier, Boston has a very healthy fiscal status, but you can imagine a community that's maybe more exposed or doesn't have that fiscal health is going to have a much different strategy and what that's going to look like. So in my role at Swiss Re, we partner with public entities all across the country, and we see a lot of different strategies that are being pursued. Some completely self-insure, right? So they take that program and they put it all on their own balance sheets. Some will purchase even more property limits, assuming that's available in the marketplace. So if you're thinking about states, right, they have a lot more insurable value. They're going to need to purchase more limits. Others buy other risk transfer products, such as cyber insurance, which I think actually now the city is purchasing, or they can purchase alternative risk transfer solutions, some of which has been touched upon today. And those can cover sort of a specific peril that may not have sufficient capacity in the market. So alternative risk transfer being parametric, multi-year single line, some of the things that I'll go through in just a bit. Ultimately, though, the use of risk transfer as a component of an overall risk management strategy is intended to smooth the cost curve and more accurately budget for specific exposures. Risk transfer can provide budget stability and enable additional budget capacity to be deployed to enhance the overall program. Now, any risk management program should always be complemented by sort of mitigation and adaptation investments. They're an essential part of a financial risk management strategy, as these investments seek to reduce the risk and scale of exposure against the hazards the risk transfer program is targeting. I really like to focus on one example from my days at City Hall. So for a long time, the city was primarily insured by one insurer, and they were very aggressive in sort of thinking about the exposure they had at the city. And so one of the things that they did is they would conduct a loss control engineering report for some of our most valuable municipal assets. They did one of these reports for City Hall, back to the slide earlier, and they found that there was a significant flood exposure at the Congress Street entrance. They then said, well, hey, we think you need to invest in reducing the risk for flood here. So we are going to recommend you install a deployable flood barrier at the Congress Street entrance. And we are going to incentivize you to do that by offering some sort of premium reduction savings by doing so. So we did it. We spent money. And I don't know if anyone went to Deployable Day, round of hands, and got to see the deployable flood barrier at City Hall. And so this light bulb went off in my head like, wow, what a great synergy of sort of an alignment of values of mitigation, insured and insurers. But in a little bit, I will also talk about the limits of that investment and that strategy. So when considering the composition of a municipal risk management program, risk transfer can offer a variety of benefits, some of which we have talked about already, such as traditional property insurance, parametric insurance, which I'll do a little bit of a deep dive in just a bit. And then a last point I want to focus on is sort of how risk transfer can provide an incredible amount of risk insights through the industry's analytical and modeling capabilities. So I mentioned earlier that our brokers helped run a probable maximum loss scenario that helped us understand what was our financial exposure to various hazards. That was some amazing insights that is in my seat at risk management, like I'd never seen in emergency management. I don't know if it had been shared to environment department, but it was really, really insightful. I mentioned the loss control report that was done at City Hall. That was also sort of stuck in this risk management hole that we weren't really getting out. But I just say that to say there are so many resources available that the industry has, and we need to do a better job of getting into the hands of our public sector partners, all of our partners, because there's so much value there, something that Charlie spoke about as well. I'll share a tool that Swiss Re has. This is back in December of 2023, we purchased a flood modeling company called Fathom, because we think that flood is a risk that is not as understood as it should be. And we think they're sort of a global leader in the flood modeling space. And so our flood models with Fathom sort of have combined what we argue is sort of best-in-class flood analysis. And it's demonstrated its value by showing that, when these sort of events, flood events happen in parts of the country where people say, oh my God, I had no idea we were flood exposed. Our models are picking up on that. And again, I'm not, selling this product, although if you want to learn more about it, I'd be happy to tell you. But just to say that our insurers have so much resources and we need to do a better job of getting them to you. And I think to Mike's point earlier, you all need feel free to ask us and implore us to let us know what kind of information we're holding on. So insurance solutions, Charlie did a good job of giving you an overview of just sort of basic risk transfer, an overview earlier, but just to give a certain sense, traditional indemnity insurance, this is sort of what we're all sort of more familiar with. It's sort of a building block of risk management and for municipalities. This is specifically intended to provide cover for municipal assets such as buildings and infrastructure. So I think everyone's fairly familiar with traditional indemnity. Parametric is sort of this exciting space. I think we've all sort of heard about it in various contexts. But this is a really unique product that provides a predetermined payout purely based upon parametric, of a specific event. Triggers utilize objective, measurable indexes to activate claims where specific conditions are met. And so what's really neat about this is through that process and through that structuring, some of the key benefits are a faster payout. So because there's no claims process involved with the parametric, payments can happen with less than 30 days. We actually had a claim paid out to a Tampa Bay or an airport in Tampa Bay. I think it was less than 4 days following Hurricane Milton. And so this was a large capital injection that got very quickly into the hands of the insured, which right now, when you think about a post-recovery strategy, there's very few instances of quick access to capital. So parametric can offer a huge benefit in that component. I also mentioned the transparent process. Everything about a structure sort of pre-established or told beforehand, so it's all very transparent and out in the open. Often the indexes we use are sort of, we use NOAA tidal gauges, we use National Weather Service data. It's all sort of very much out in the open. And it's also very tailored and structured. So we have conversations all the time where we pitch a structure, the client says, actually, we want this, and we go back and forth, and it's a very collaborative process in terms of development. Lastly, the piece that I think is really exciting about parametric is flexibility of the use of funds. So in a traditional indemnity, the money has to go back towards replacing the damages of said event, assuming that's what the policy states, blah, 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 blah. Parametric, though, the insured proceeds can be used at the discretion of the insured. So when that money comes in, they can decide how they want to spend it. So we've seen clients that want to spend it on buying down their deductible for their property insurance. We've seen them put aside money for direct costs that emerged after an event that they didn't know was going to be a concern for them at the time. But that flexibility of funds is really exciting. And I think when we have customers that buy a parametric and then end up getting a payout, they can't believe that all of a sudden they have a check with sort of no strings attached. It's a pretty remarkable tool. And we just argue that it should be one part of sort of a diversified risk management structure. I'll mention one more, give you a little bit of a timeline between parametric and indemnity. I'll give you one more, that's coming up, one more tool in the alternative risk transfer space. So this is called a multi-year single line. And so this is a tool that's supposed to provide access to a sufficient and guaranteed capacity for a single peril over a multi-year term. So this is another way to sort of smooth the cost curve and create a more stable budget. And oftentimes we see a lot of customers looking to this solution when they can't find traditional capacity in the traditional market. And I just highlight these two to say that, you know, the risk management strategy I talked about earlier for the city of Boston, self-insurance, traditional property, and relying upon FEMA. There are so many other tools that are out there that can lead to sort of a diversified risk management approach. And again, I just think it's worth knowing that these exist. And certainly, you know, we're happy to talk about more of these solutions. And oftentimes, too, they're intended to solve a specific problem. And so, to Charlie's point earlier, parametric is not a silver bullet, but it can solve a very specific problem somebody has. And that's where it's best utilized. And so we want to make sure we're matching the specific challenge with a very specific solution. I'll conclude just on this section, just giving an overview of how a municipality approached the alternative risk transfer space. So in California, atmospheric river is a huge concern for a lot of municipalities. And there is just not a lot of flood capacity in the market, in the traditional market. So I know actually for the city of Boston, when we bought that $300 million all risk limit, we were actually sublimited for $125 million of flood. And there were certain properties that could only be paid out a certain limit as well. So like there's a lot of restrictions in the traditional market. So the municipality came to us and they ended up buying a flood parametric solution where they have $2 million of capacity where, again, depending on certain triggering levels, they would get a direct injection of capital that they could use at their discretion to steer their initial recovery efforts. So just to say, you know, parametric is purchased by a lot of municipalities now. Maybe not a lot, but a few. And we certainly think it's sort of a valuable opportunity for other municipalities to sort of think about as part of their overall risk management strategy. So we've talked a lot about challenges to the public sector so far. And I think a few people have already talked about sort of the property market challenges, whether it's rising rates, reduced coverage, and carrier exits. That has an impact on municipalities in a lot of ways. One, it just makes the cost of purchasing insurance more expensive. And so one of the strategies we did at the city when the rates really went up in 2022, 2023, is we just took on more self-insurance. The cost was so expensive that we thought it was financially responsible to sort of buy less, but it always made me a little eerie because that just meant we were more exposed to a sort of larger event. We've talked about sort of the limits of modeling and incorporating all the different mitigation investments that are happening across the country. And so I'll go back to that City Hall example. We were incentivized to put this deployable flood barrier at City Hall. My question after the fact was, well, what if we had made that same a similar mitigation investment sort of maybe closer to the harbor that would have had a same risk reduction benefit, but it wouldn't have just protected City Hall, but it would have protected all our businesses and residents that live behind that intervention. Models right now are not capturing that. We are very good at sort of capturing like the deployable flood barrier at City Hall, a fortified roof, something that protects the physical asset. We are not as good at sort of capturing the larger benefits into our models to date. I think Mike can probably speak a little bit more to that. I'm not a model expert, but that is definitely something that is challenging. And I think when I was in my role, and certainly we hear from a lot of clients now, that seems to be sort of a major sticking point, major challenge. We've talked about the growing protection gap, and so how that puts more of a burden on local, state, and federal governments. Clearly, this is going to be an issue, and something I thought about a lot when I was with the city is if we're experiencing this same hard market back in 2022, 2023, what are our residents and businesses facing in the city? I'm sure they're dealing with the same affordability challenges. And what do we know? I think that was another part that we really struggled with at the city was understanding, well, what is the protection gap? How do we quantify it? And that's something that I think Insure is doing, trying to capture that total cost of risk. But that is a real challenge, is sort of understanding what that protection gap is, because then you can figure out what we're actually going to do about it. We talked about property value decline. And lastly, I'll just say this downgrade of municipal bond ratings. This one is pretty scary just from the sense of previously, downgrades following natural disasters have been based on property damage and the potential loss of tax revenue and the cost of rebuilding, not on risk necessarily tied to climate change. But that's changing. Physical climate risks are an increasing credit consideration. And in January of 2014, S&P's global ratings downgraded Los Angeles Department of Water and Power 2 notches from a near perfect AA- rating to an A. Bond values fell, default risk rose, and some bondholders sold at a loss. So that new rating means that if LA Department of Water and Power is going to issue new bonds soon, it will have to pay higher interest rates to compensate buyers for the heightened risk. And this wasn't just this one department. S&P issued warnings for multiple municipalities throughout the LA area. So this is a pretty scary sort of outcome and potential challenge that the LA communities are going to have to face now, but potentially much more municipalities around the country in the future. Opportunities, yes, last slide. So just in terms of municipalities managing their own property program, I would say, and this gets to some of Mike's points earlier, is like really engage brokers and carriers on the resources that they can offer. I think that was sort of a turning point, or a light bulb went off, as whenever we would go to market, you typically submit your statement of values, and you could just stop there when you go out for renewal every year. But by having conversations about the mitigation investments we're making, the different sort of risk reduction policies and strategies we're pursuing, the building codes we have in Boston, that has an impact on the underwriting process. So the models are one thing, but then the underwriters sort of then do a much larger costing analysis. And that's where there's a little bit more of a, not so much a science, but an art in underwriting. And that's where there is an impact. Now, we at the city of Boston had a little bit more leverage to do just that. That's not going to happen with a homeowner sort of maybe making that same case to say, hey, the city of Boston invested in X, I should have a risk reduction in Y. That's going to be a little bit harder, but I would certainly say, again, there's so much resources that brokers and carriers have. I implore you to sort of tap into them as much as possible. And then just some ideas around reducing the protection gap. A lot of this, we thought about, well, if we knew what the protection gap was, how would we address it? So one of those ways is through a variety of sort of risk awareness campaigns. We don't want to live in a world where people are saying, I didn't know I was at flood risk, right? Even though they all of a sudden now have 11 inches of water in their basement. So I think there's some really cool and innovative tools out there that are helping to illuminate what that flood risk is. I always like to tell people about Flood Help NY. Maybe Theodora, you're familiar with this a little bit, but it's a great resource available that sort of helps folks understand what their flood risk is, what is insurance and how it can support sort of their financial risk strategy, and then also what are some mitigation investments they can make, both low cost and high cost. There are some pretty interesting incentivized mitigation efforts. And am I running out of time, or do I have a couple more minutes? Run out of time. Great. Well, I would say that the municipal managers of insurance, like FAIR Plans or NFIP community rating systems, those have some really great examples of tying mitigation investments into reduced premium. And then just lastly, I'll say community-based catastrophe insurance. So this idea that there's an intermediary, such as a local government or community organization, between the insurer and beneficiaries, takes out a policy that can benefit residents to ensure more widespread financial assistance after a hazard. For anyone who's come across Caroline Kowski at the Environmental Defense Fund, she is sort of a leading thought practitioner in this space. And there's a really good article on her Insurance for Good nonprofit website right now that I highly recommend folks to read about a community in California, Ileton, I believe, that's purchased a community-based insurance product. But also she was a lead architect for City of New York's community-based catastrophe insurance product, which is what the focus of our next speaker is going to be on. Swiss Re was a capacity provider, but Theodore is going to give you a much better summary of that process and how it's going today. Thank you.
All right. Thank you so much, Ben. And as pointed here, I did want to point out that, keep this in mind. There was a little bit of strategy in pairing these presentations back to back here. Before opening questions, just also want to thank you for giving us a little bit of a 2-for-1 here, the perspective of being on the municipal side and now also in the insurance space. So with that, open it to questions. Yep.
Hi, Nasser Brahim from the Mystic River Watershed Association. I was curious on the parametric insurance part. You gave some examples of communities that got the payouts. But on the insurance side, is there a similar risk that it doesn't make money? There's too many catastrophes? Will we be in the same position where parametrics are pulling out of communities, 10 years, 20 years from now? I'm just curious on their perspective, how financially attractive is it for reinsurers to participate or insurers to participate in providing that kind of coverage?
So our NatCat modeling and structuring teams look at parametric as another product of which we can offer in the market. And certainly we hope to have the best sort of hazard analysis that makes sure that it's something that is a viable product in the market. So I would say yes for now. I'm always surprised at how much capacity we have deployed around the country, even sort of at our riskiest areas. So for now, it seems to be working, but certainly there is a future where maybe it's a little bit more challenged for sure. And that'll change, how we structure it or sort of the pricing of it. Again, it gets back to that point earlier, insurance is supposed to sort of be a price signal. And so parametric is also going to be reflective of that signal.
All right. I think we have a virtual question next.
This question is from Ellie Baker from Horsley Witten Group. Ben, can you talk more about how FEMA was considered in your risk management approach in Boston, or how it is typically considered within a municipal risk management approach? How much are communities depending on FEMA and federal response in their insurance or risk reduction approaches?
I will say we rely upon that federal public assistance program a lot. It is definitely sort of a federal backstop, and it heavily influenced how we thought about our own risk management strategy. Now, FEMA, also doesn't necessarily want to be in the space of just being the sort of insurer of last resort. So they do have some requirements such as obtain and maintain. So after you've received public assistance, as a municipality, you do have to purchase your own sort of risk transfer solution. But some of that is a little bit murky and can be, you could just buy a very limited policy and still be heavily reliant upon the federal government. Clearly, there's changes in the new administration that indicate, or we don't know what's going to happen with FEMA and what that balance will be, but I do think municipalities are going to have to rethink that calculation of how much they can rely upon federal resources. And maybe, there might be some more, I think there's a concern about sort of attachments to federal aid, but some of that I think could be used in the right way to sort of incentivize building back better or building back in places that are going to be a little bit more sustainable and viable for safety.
I did see one more question over here.
Thank you so much, Emily Norton, Executive Director of the Charles River Watershed Association. And for the purposes of my comment, you and I have talked about this. I also served as a city councilor in Newton for 10 years. So something that I haven't seen sort of referenced is the fact that water does not respect municipal boundaries. And so Boston is only going to be as safe as decisions made upstream. Yet here in Massachusetts, we do not have regional government to help make that decision. So you're not even getting to the good decisions about insurance or whatever, because you don't have, as a local official, you don't have control over what happens elsewhere. You also, not to scare you all, but you should be very scared. They don't understand any of this. I say this as a former one myself. I say this, we work with our 35 cities and towns, and I know the other watershed groups would agree with this. Your local officials do not understand any of this. And a model that I would say to look for as an example is we also don't understand finances, a lot of things that they make decisions on that they don't understand. But when you have ratings agencies that rate your city or town on financial risk, you get your bond rating and so forth. I'd say that 99% of the local officials don't really understand any of that, but you get a report and it says this is good and this is bad. So that idea of bringing climate risk into that still would take a long time to make good decisions from that. But it's really vital. So we're not even at the place where we can be making these better decisions until we fix some of those things. I'd love your take on that.
Yeah, good point. Yes. Look, I think these challenges that municipalities face are very complicated. There's a lot of various factors to have to consider. Certainly, I think there is some financial literacy and sort of risk analysis efficacy that we could do better. And it's going to take just more conversations like these. It's going to, I think we're all going to have to sort of face the future too. I think, some of the reports about the non-renewable rates, Massachusetts being the fifth highest in the country, I think it's not just Florida, it's not just California, but I think it's going to force our policymakers to sort of consider those impacts happening already here locally.
Thanks so much, Benjamin. Keep more questions for the panel.
All right. So now our last but not least speaker is Theodora Macris, who's a senior program manager at the Center for New York City Neighborhoods. She currently manages the development of the Flood Recovery Fund, sounds really applicable, an emergency grants pilot program that supports homeowners affected by severe rainfall flooding. Macris hopes that the program's outcomes will build awareness around the need for substantial industry change and will prioritize the specific needs for low and moderate income families and improve the coverage gaps in flood-prone communities. Thank you, Theodora.
Thank you. Just want to make sure I know how the slides work. Possibly. Oh. Sure. Yeah, I was like, okay, I'll get my slides organized, do some deep breathing. Cool. Well, it is a beautiful day out. Thank you all for having me. I was really excited to be invited to speak on this today. I hope the conversation dovetails nicely with everyone who's spoken before me, especially Ben, obviously, but I hope this is very applicable to all of you as well. Okay, great. Hi, my name is Theodora Macris. I'm a senior program manager at the Center for New York City Neighborhoods, currently managing the development of the Flood Recovery Fund pilot program, which I'll be speaking about today. Also want to just shout out the center. We are a nonprofit based in New York State that aims to promote and protect homeownership affordability through direct services, such as the recovery program and legislative advocacy. And the Flood Recovery Fund really aims to lower the protection gap and support low and moderate income homeowners throughout the 5 boroughs. And we do that through utilizing a parametric flood insurance policy, as well as a community-based model, which I'll be discussing now. And I can do the next one, I think. Okay, beautiful. This is just a brief agenda that I'm going to share out now. The research findings that I want to just briefly discuss, I think will be applicable to many of you who are considering financial resiliency in your communities. I'll briefly touch on parametric insurance and the community-based model, a description of the Flood Recovery Fund, a lot of the programmatic work that went into developing FRF, and finally, the partnership team without which none of this work would even be possible. So that's a bit about what we're going to discuss. And beautiful. Okay. Like I said, I wanted to sort of take a step back. I know that we've shared a lot already today, but I think it's really important to narrow in on some of the specific research that led us to this intervention. Several years ago, my organization, along with the Wharton Risk Center and the New York City Mayor's Office of Climate and Environmental Justice, received a National Science Foundation's Civic Innovations Grant to implement a climate resilience intervention. And all of this work at the time was led by Dr. Carolyn Kuski, formerly at Wharton, now at the Environmental Defense Fund. And her team of researchers found that climate disasters really do function as financial shocks to households where costs increase or incomes temporarily or permanently decrease. And that can have devastating and long-lasting economic effects on both the household and community level that can be really expensive and difficult to come back from. They also found that lower income Americans and communities of color suffer disproportionately from climate events and recover less quickly or fully than wealthier residents. And finally, the two main gaps that they see in part of the recovery process is that funds are incredibly delayed. So whether you have insurance or are relying on FEMA individual assistance or other philanthropic dollars, that funding can come months, sometimes years later, and lower income households simply just don't have access to credit or savings to supplement them in the short term while they wait. So there are these sort of cascading downward negative effects. And finally, if the funding does come, if it comes, it's often very restrictive, as we heard earlier, and cannot be applied to the wide range of needs that households typically face, the sort of unexpected emergency costs like needing to pay a babysitter so you can go back to work, or replacing food, paying down your mortgage, things like that. So those are the sort of existing gaps that her research found and were affirmed by the homeowners and practitioners that we spoke to in New York. So once we identified the gaps, it was time to come up with a solution. Maybe next slide. And what we found was being able to utilize something called parametric insurance to expedite payments quickly. And I know parametric was touched on in the last panel, so I don't want to spend too much time on it. But what I will say is our policy, it covers rainfall flooding specifically because it's a peril we're seeing increasing in both frequency and severity in New York. It particularly affects inland communities outside of FEMA flood zones who aren't obligated to have insurance as per their mortgage requirement, but are highly at risk of property flooding. After Hurricane Sandy, New York City has done a tremendous job of sort of beefing up the coastlines. But after Hurricane Ida and other flash floods that we've had, it's really put a spotlight on the specific vulnerabilities that we have off the coasts, inland, really impervious surfaces, old water systems, it's a really hard place for water to move. And so that was a specific focus of the parametric policy. So that's what sort of makes this pilot unique. The second aspect that makes this pilot a little different and unique is that we've implemented it through a community-based model, which is sometimes referred to as an aggregator model, where our organization has taken out a policy, but the ultimate beneficiaries are New York City homeowners. The image on the right tries to illustrate how the dollars flow from the center up to our reinsurer, which is Swiss Re, back down to the center, and then ultimately to households. So how does this work in practice? Well, we currently have an insurance policy. I mostly, but my organization, we sort of monitor the weather. If there's a storm that seems like it might sort of rise to the level of a qualified event, we submit a claim to Swiss Re. They tap the data provider who reviews the data and confirms whether or not a qualified event has occurred. If it has, a predetermined amount of money gets transferred over to the center, and that payout is what essentially launches the recovery program, and that money is used to make grants to qualified homeowners. At the time that we were conceiving this pilot, we questioned whether or not an agency within New York City government could take out a policy, especially because one of our goals is to really scale this up citywide and make it even more accessible. But what we learned at the time was the city charter really prohibits government entities from providing cash grants. So then we had to investigate whether or not a program, organization like ourselves could take out a policy. To do this work, we've fundraised for 2 years for insurance premiums and brokerage fees in order to place 2 policies consecutively. So those 2 ideas, right, parametric and the community-based model is the foundation for the Flood Recovery Fund, which we're all here to learn about together. And that, just to reemphasize, right, this is really a pilot program that is made to function as an opportunity to stabilize household finances. It's really not a supplement for your own insurance. It's really not even to make you whole again. It's just to sort of minimize the chances of financial precarity right in the aftermath of an event. So the policy is currently active. If there's an event that triggers the policy, well, that money is what launches the program. So at that time, an application will become available on floodhelpny.org. Thank you, Ben, for shouting that out. That's a website that we run with several of our city and state partners. We get a lot of traction on the site when there are terrible storms. So that's sort of a natural place for us to upload an application. People can go to it and submit one themselves, or they can contact one of their network partners. The center's network partners are a cohort of housing counselors and legal service providers throughout New York State who counsel homeowners on a range of issues like foreclosure prevention services, deed theft and predatory speculation, as well as counseling people through severe weather events. So our network partners can also be another stop for people on their way in order to learn about this program. The center also operates what we call the Homeowner Hub, which is a multilingual call center that operates during business hours. We get calls every single day, but especially after these like severe climate events, people can call in and ask about resources and information, and they can submit an application there or be referred to a network partner in order to learn a little bit more and maybe even be counseled on making their submission. And because we have limited funding at the moment, our network partners and our Homeowner Hub are really best positioned to refer their most affected clients to us at this time. Okay, moving on. I wanted to also just discuss a little bit about the program's development. We are in the pilot stage right now, but we've taken a lot of insights from our network partners who've counseled clients through several weather events to try to create an application and a process that is really reflective of homeowner needs, especially during these highly stressful events. We wanted to really ensure that applicants didn't feel burdened by the amount of paperwork and proof of loss that's really characteristic of similar programs, and try to make an application that they can easily engage with and not feel too overwhelmed by the process. And that exercise really allowed us to create a very simple and basic and streamlined application with a low barrier to entry to limit the amount of drop-offs and incomplete applications that we might otherwise see, because we really want people to engage with the program and hopefully, get some money to help repair. So our eligibility criteria and documentation requirements is really consistent with other center programming that we've developed and is aligned with the communities that we intend to serve throughout the pilot. I wanted to also just take a step back and discuss the policy in a little bit more detail. I suppose parametric policies can be designed in a number of different ways, depending on your goals and what you're hoping to ensure. Our payout is proportional to the magnitude and severity of the event. So a more catastrophic event will yield the largest payout, and a more moderate event will yield a smaller payout. And we applied that same principle to the grant award sizes to homeowners. So homeowners going through a more catastrophic event will receive a higher grant award size than they would in the sort of moderate scenario. Okay, our program has not yet been launched yet, but we have done everything that we can to develop all of the processes, escalation processes, in order to be able to launch as quickly as possible. We are still looking for funding for a third year. So if you want to chat after about maybe connecting us to some funders and folks to talk more, that would be amazing. So my presentation isn't very long, and this is the last slide, but I thought it was really important to shout out this partnership team because of all of the collaboration that we've done together over several years, starting with Dr. Carolyn Kuski and Environmental Defense Fund for all of her work and expertise on disaster insurance and risk transfer. Guy Carpenter, who served as our broker throughout this process and has provided just a ton of technical assistance and guidance to our entire team, but specifically to me. Swiss Re, who is very much in support of our mission and just for their willingness to work with us has been really, really fantastic. The New York City Mayor's Office of Climate and Environmental Justice, who as a policymaker is really designing a lot of really innovative programming in New York, and we're always really happy to have their support. NYC Emergency Management, who's responsible for deploying all of the sort of disaster response programming in New York and is very much in support of us. SBP as a disaster training and preparedness expert. And then finally to Raincoat, a climate tech startup. They're our most recent funder and are really just incredibly helpful to me on the program design, as well as helping us through some of the technical aspects of the policy as well. So I illustrate this just to say that this is a really big and collaborative effort. Each organization has a wealth of knowledge that we can apply to both the policy's design and the program's development, and really wouldn't be able to do any of it without this team. And I wanted to just say to all of you who may be thinking about, is this an opportunity that I can leverage in my community? Where do I even get started? I would say maybe just focus on 1 to 2 problems in your community that aren't being addressed by the current suite of services and decide whether or not insurance is something that could be applied to help solve it. I think the more, and this was mentioned several times already, but the more pilots and initiatives that we can really deploy, we'll be able to test what works and what doesn't and how they can be sort of like amended. But I think it's really important to start getting into a lot of this work. And it's not easy, and it is a lot of work, but I think the payoff is really, really great. And I'll just end by saying too, the parametric policy and the community-based model isn't necessarily a silver bullet. In fact, I think it has to be like cascading interventions happening all together and at once. But we believe that supporting homeowners directly after a climate event to minimize their chances of financial precarity is a really important gap to be filling. And we feel really, really fortunate to have the opportunities to do and are really, really excited about the program. So with that, my time is up and I'm available for any questions if you have them.
All right. Thank you so much, Theodora. And I do also want to especially thank you for being here, coming from, starting in a non-insurance side and working your way into this by the nature of the work. Again, I will point out the window. We have plenty of impervious surface environmental justice areas that many people in this room have contributed to detailed flood models that show these types of flooding outside of FEMA flood zones. So I think it's very relevant, this topic, to this audience. Any questions?
And please introduce yourself too.
Hi, Theodore. Thank you for your presentation. I'm Eric Roberts with the Nature Conservancy. I lead our Nature for Insurance work, building on Mike Beck's really great work. So one of the challenges that we have is funding the premiums every year. It sounds like you're exploring that as well. And I'm wondering, what are you all thinking about in terms of a long-term source of funding for the premiums rather than fundraising every single year, which isn't always sustainable?
It's not. And that is exactly what my job is coming up against right now. So the answer is I don't really have a solution. We've actually met with Charlie and I'm trying to facilitate more and more of these conversations because I think having sustainable and predictable funding sort of eliminates all of the extra work that has to get done as the coverage period ends and you're starting to have anxiety about whether or not we can continue this for a third year. So I don't actually have an answer. Let's chat after because I'd really love to even just learn about solutions that are out there and see if they're feasible for our organization. But yes, it's absolutely a problem that we're coming up against and are really anxious to solve.
I think we have a virtual in time for one more after that.
This question is from Joy D. Can the recipient use a grant award to purchase a flood insurance policy?
Hello? Yes, they can. So as it was mentioned earlier, not only is the recipient of those funds, aka the center, sort of agnostic to how we use them, we're going to funnel that right out to homeowners through an emergency grant. But yeah, absolutely. Homeowners can apply that funding for whatever they want. If they have, let's say, some damage and the money that they receive is enough to cover it, and now they have this like extra money, they can use it for all sorts of things. But certainly they can apply it to purchasing flood insurance of their own, or even making weatherization and resiliency upgrades as well to sort of prevent a future damages encouraged and welcome. But yes, absolutely.
Seeing a question over here. Introduce yourself.
Yeah. Deanna Moran, I'm the Chief Coastal Resilience Officer for the Massachusetts Office of Coastal Zone Management. You might have mentioned this and I missed it, but what is your annual premium? And then my other question is, you mentioned that the payouts could be up to like 1.1 million depending on the severity of the event. Is that the cap for your annual policy? Or if you had multiple events that hit that threshold in a single year, would you be paid out up to that 1.1 million multiple times over the course of a year?
So two good questions. I'll start with the last first. It is the cap. So it's not a one-shot deal. We can receive multiple payments until the coverage period ends, or depending on the frequency of storms, but 1.1 million is the cap. And I'm sorry, your first question just again? Oh, 100,000 for 1.1 as a cap.
I think we have one more online question.
This question comes from Mary Beth G. Do you build in resilience or building back stronger requirements into your program?
Not for the flood recovery fund. We haven't had a deployment yet, and so we don't have enough sort of case studies under our belt to learn if we should be making changes to the program itself to require something like that. But my organization separately has several programs that we manage, including resiliency and retrofitting and things of that nature. We're trying to also think about how do we tie some of this how do we tie this program back to some of the other programming that we do, so that if we have people in our pipeline who may have been affected by X storm, maybe we can introduce them to the programming that helps them with their resiliency and retrofitting. So more to come on that, but we're trying to think long-term about how do we provide a more holistic suite of services so that people not only are getting the funding that they need in that moment, but can be making sort of smarter long-term investments to their property as well. Okay.
All right. Thank you, Theodora. And at this time, we will roll right into the panel discussion. So I will invite our speakers back up.
Sure. I'll sit right here.
I also have a small request for our panelists. All of those mics up there are on. Please leave them on, because there's an annoying delay if you try to turn them off. And you'll start talking and be confused. So please just leave your mics on.
All right. So I know we are going to have plenty of questions based on the ones we didn't get to over the course of the discussions. I did want to start obviously thanking all of our speakers here. Yeah, I'll address the very bleak intro to this discussion that happened. So we definitely heard earlier today from Senator Whitehouse, the very much may the odds be ever in your favor speech that talked about, you know, crashing markets, increased worries of collapse, our traditional institutions that we rely on potentially being under threat, and cascading risks. So I think what was very exciting, and the reason why we constructed this panel in particular, is the opportunities, the cascading possibilities in the opposite direction. So in each of these presentations, we heard about larger system benefits, you know, layered benefits that communities might see from these. So I'm going to start with a hopeful question, one that is the Ayanna Elizabeth Johnson question, the what if we get it right question. So, you know, what could that look like? What happens if we, you know, empower communities, add new options for otherwise vulnerable populations, you know, give municipalities new options, and increase nature-based solutions and conservation financing?
Want to go? I think there is a path forward. I've been in the industry for a long time, 35 years, and nobody's ever until very recently from outside the industry say, "Oh, insurance, I want to kind of talk to you." But like the last 2, 3 years, there is a real kind of interest, which one makes me feel like, okay, there's pain and I think we're moving towards, maybe too slow, but we're moving towards hopefully getting it right. And I think what it looks like is people are more aware of their risks. They don't necessarily have easy decisions, but they will be able to make some decisions. And I think the system is there is enough capital overall. It's just, I think, not aligned to fund these risks. It will change things, but I think we can get to a point where there is a kind of that positive cycle that I talked about earlier, where people understand their risks, they invest in mitigation, which positively affects their kind of future both costs and revenue streams, and see the value of investments in mitigation and work towards a more resilient future.
I'm happy to go next, or do we want to go down the line? Okay. Well, I think I'm very hopeful about the community-based model that we've developed, but until we have a few case studies under our belt, of course, it's not a sure thing, and we're not entirely sure how it'll look, but I at least think in the short term, one of the benefits that I think we would see in New York is after all of these climate disasters, there is it's almost just like a magnet. There's like the predatory speculators and these like vultures who come in to try to buy people's homes out from under them because they know they're in a financially precarious situation. And it's really devastating, and it has sort of ripple effects on the culture of communities and has all sorts of issues. And I think what I'm very hopeful about is being able to provide a service like this to sort of try to eliminate that from our equation, so to speak. It's really devastating to sort of walk down your neighborhood after an event and just see for sale signs and know that people aren't getting what their home is worth. And I would just love to see that change. And so I'm very hopeful that being able to scale this up citywide would at least try to minimize that from happening so that people can be in their homes long term and pass them on to their children and enable that sort of heirs property cycle to continue, which at this point is really disrupted after these major climate events. So just to bring it back to like home ownership and equity as well, I think that's a major component.
And just to follow up on that point, again, I'll point to Dr. Kowski's research. Encourage you all to look at it. But she found that recovery in communities is directly correlated with the higher penetration of insurance coverage. And so I think this is a really key unlock to think about how do we, getting back to my sort of earlier point about how do we stimulate sort of an efficient, effective, and equitable recovery, is how do we get those resources out quickly in an event so people can stay in their home, so they can recover quicker and faster, and we can create a more resilient society. But I think that sort of unlock for me was really interesting, and sort of figuring out how do we do that. I think parametric is one way. I think to Charlie's point earlier about risk awareness and different opportunities once you understand what that risk is. But I do think there's a lot there that we can continue to be doing. And I think the New York City pilot is a great example and something we should figure out what makes sense to scale across the country.
No surprise for me. I'm going to give you a little bit of realism and then the optimism after that. What's going on in the federal government right now is a disaster. I view it as a disaster. I treat it as a disaster. And in that regard, look both in terms of the response to some of our colleagues that are being impacted by changes made in malice and the like, and view that as incredibly important. By the same vein, by looking at any disaster, whether it's economic or natural disasters, we look for opportunity in that, and the growth of nature-based solutions has proceeded after disasters, after the economic disaster, after Gulf oil spills, after hurricanes. So, it's incumbent upon us to try to find some opportunity in that. Money's not disappearing. It's just going other places, and so we've got to be smart enough to still try to marshal those resources to help protect people, property, and nature, because the risks aren't going away either.
All right, thanks everyone. I know we're going to have a ton of questions, trying to get in as many as possible. My one request is that the questions contain a question. We'll start here.
Fun fact, please have a mic because otherwise the virtual folks can't hear you.
My name is Bill Golden. I'm working with Emily Norton and the Charles River Watershed Association. Since 2004, we've had 18 of the 20 most costly storms in the history of the country. After Katrina, after Sandy, after Ike, after Ida, everybody said, well, maybe not this storm is going to change policy, but the next one will. So I congratulate everybody that put this together and for all of you being here, because it's not the next meteorological storm. It's the insurance and mortgage storm that's coming, and the economics of that will change policy. Back in 2012, 2014, a woman by the name of Judge Alice Hill, who was the then National Security Advisor to the President on resiliency, had a forum at the Wharton School. And all 5 reinsurers were there, all major primary insurers, and the 3 commissioners, the 3 insurance commissioners from Connecticut, New York, and New Jersey. Very small, very high-level discussion. And it was like putting Cobra and Mongoose in the same room. Nothing came of it. And one of the major blocks in this was the failure of the insurance industry to inform public policy makers. I've worked at every level of government, from White House down to City Hall. And that gap, which was referenced earlier, is incredibly important to cover. At that time, at the time of this Wharton meeting, the main interface between the insurance industry and public policy makers was rates. And it was pretty much focused just on rates. As we've begun to make the shift from disaster relief to disaster prevention, to reduce risk, to reduce rates, to control and predict things better.
Sorry, do you have a question here?
Question's at Ben. What has happened since then to inform government and to break through the curtain? And the curtain has been the failure of the insurance industry to reveal what's going on in underwriting, to inform government, to give them the trust in the insurance industry, not just rates, but risk analysis.
All right, let me speak on behalf of the insurance industry. I feel like there's like a graduate thesis in here we could write a whole paper on. I will say, I think some of the work that we have tried to do, and gets back to Charlie's point about insurance being a risk indicator, is sort of be able to deploy capacity where we think we are comfortable with the risk. And so I remember going to an event down in Miami last summer, and I was asking our underwriters, well, how much capacity do we have deployed in Florida, which Mike mentioned is sort of ground zero for the insurance market imploding. And we had a substantial amount of capacity being deployed in Southeast Florida. I was like thinking, well, why? I feel like everyone's leaving, but not Swiss Re. And the idea was that we are making those investments in places where there are buildings that are built to a strong building code, that have resilient infrastructure that's being built in. So we are indicating through our investment that we like these sorts of risks when those investments are being made. Now, that's a portion of the overall risk, but I do think that is one signal that we are trying to send, is that when the risk is managed correctly, that's when our capacity can be deployed. When it's not, that's where we are less likely to have that kind of appetite.
Can I just add to that? What Ben just said is the way the industry operates. That's the way it's designed to operate. And I think posing the question to the industry, like, what are you going to do for us? It's always going to be this way. And I think the risk, the 50% of risk that is uninsured, is on the communities. And I think that the way that you get the industry to change behaviors is to change the system and actually compete with the industry to say, we're not going to just take fair plans are designed to take the worst of the risk, and then everything else can go to the industry. As that gets bigger, fair plans and residual markets only work when they're residual markets. And we believe, like, our whole kind of approach to, like, we need, public-private capital stacks that are mission-driven, connected to the community, creates an environment where some carriers will just choose to kind of do exit and not participate, but others, and I like Munich Re is already leaning in. They will lean in even more to say, okay, we're going to try to innovate. We're going to try to do this, and we're going to try to close that protection gap. It's not going to come just through conversations. It's going to come from actual kind of market changes.
Do we have a virtual question, Jackson?
This question is from Ellie Baker from Horsley Witten Group. Even if individuals decide they can absorb the risk, for example, if they're affluent or self-insured, the municipality still needs to provide the services to those structures, and that infrastructure cost is spread across the municipality. How does insurance fit into operation and maintenance of public infrastructure? How is public infrastructure insured?
Public infrastructure can be insured if, again, it goes back to that financial risk management strategy that the municipality wants to take on. So they can decide that we want to buy a policy. We can decide that we want to completely self-insure. But it comes down to that decision-making process within the municipality. How are they going to manage that risk? Are they going to retain it? Are they going to transfer it? Are they going to mitigate it? Are they going to take all of the above?
I'd like to just add to that, and that we are going to have to think differently about this in terms of how we fund adaptation in general. So, great, insurance can be a part of that, but more broadly speaking, we have to find new ways to fund that adaptation. And right now, the only way to do that is through debt. And so far, we're really not going to do that very often. We have at least created some more opportunities for public-private partnership in mitigation markets. We've been working on kind of similar ideas for adaptation markets. So I think that there's a real opportunity there. Part of what we're going to actually have to recognize in general is that we only make these kinds of investments after disasters. So you should have a plan in place for adaptation to spend post-disaster money. That's not the way I'd like, it's not the answer I'd like to give here, but it is, again, the realistic answer of what we need to do and be prepared for.
Right, another one in the room. We'll go here.
Hi, Jill Valdez Horwood, Bar Foundation Director of the Waterfront Initiative. I have a curiosity, and my brain thinks in this way, and so I'm in a panel of insurance folks. It's not a one-for-one, but P&I clubs in the maritime space, a long time ago, ship owners started to not be insured by insurance because it was expensive, because it was unpredictable, but it was a requirement or a need that came about. And so P&I clubs decided, forget insurance, we're just going to pull our risks and cover each other, knowing that we are highly at risk and there's a lot of valuables that we have to recover. Is that something that has been thought about, considered? Could that be a thing? Again, general curiosity. I don't have a well-crafted question, but it's a thing that my brain does because that's my background.
Yes, I would say, when you start thinking about 50% is uninsured and it's kind of not even planned for in terms of financing wholly, we think that this broad kind of bucket of self-insurance, which can include a lot of things like, risk retention groups, which essentially that's what you just described as a type of risk retention group. But there's a lot of other ways to say, hey, we're already taking this risk. How are we going to finance it? And if you start thinking about that and planning that, then there are ways to kind of engage the industry to say, hey, I know your appetite is X, Y, and Z. Could you shift it a little bit and maybe plug into this piece? It changes the conversation. And we think, and you're seeing like captive insurance companies are one of the fastest growing areas right now, because it is essentially people starting to say, you know, we need to kind of figure out how to finance this risk on our own. So there's a lot of opportunity there.
Yeah, we're working on one such experiment with Guy Carpenter on this, pooling risk between communities in Florida facing flood risk and those in California facing wildfire risk. With any luck, there's a separation of those probabilities of risk, and so some opportunities there.
And there are public entity risk pools. So I believe here locally, it's the Massachusetts Interlocal Insurance Association. And so they work with municipalities across the state to participate and offer, whether it's property insurance or cyber insurance or whatever it may be. So that model exists and exists around the country. So I know National League of Cities and the Association for Group Risk Insurance Pools, AGRIP, are some other resources to look at to see how they're currently managing their risk efforts.
All right. Take another virtual one.
This question is from Jeff D. Communication came up a number of times, including to convey the science, mitigation investments, and insurance benefits to stakeholders to drive up action, investment, and uptake of insurance. How can a technical concept savvy communications company contribute to the effort? How is or should enhanced communication efforts be funded?
Theodore, is it cool to start with you?
Yeah, sure. I think it's probably obvious by this panel that I'm not an insurance expert, so I'll do my best to try to talk through the sort of more community-oriented parts of this discussion. Education comes up a lot. Communication education comes up a lot, especially as we've started to work on this program. It's not something that a lot of homeowners, it's not that they're not familiar with it, but it's prohibitively expensive, and therefore it's like, my hands are tied. It's not something that I can engage in. So we have a homeowner help desk. We go to tons of community events all over New York City and New York State to talk all things, and then like insert issue here. So in this case, it's insurance. It's learning about how to lower your risk. What are some financing options for you that's available at sort of every level? Are there payment plans that people can get involved with? So I don't know how like a savvy communications company can get involved in the work, other than to like meet with us and see if there are like more persuasive ways to socialize this idea to people. But what I will say too is like, what I found in the work is you can communicate as much as you want. If it's not attached to financing, it's not that people don't want to do it, it's that they can't afford to do it. So it's not necessarily a choice at that point. But so that always just seems to come up, and I feel like it's important to just call it out that often people just don't have choices. But we do a lot of community engagement events, not just for my program, but for all the programs that we deploy with all of our city agencies to meet people where they are. We do it in multiple different languages, in person and online, for seniors, for new homeowners, so that we can really be available to answer all the questions that they have. So communication, education is certainly at the top of our list.
Yeah, we think communication is incredibly important. I just showed a few of the kinds of visualizations that we're working on, being able to take these models and results and potential solutions out of black boxes so that you can visualize them in the way that people are used to seeing kind of high quality visualizations is incredibly important. If you go to our YouTube site or join my LinkedIn, you'll see some more. I post a new visualization of risk and solutions that our team is working on every other week or so. Just recently with the event that I showed you where the wharf was damaged, our team of modelers, some of whom are here, worked quickly to develop a model for Santa Cruz and then show the results there in Unreal Engine. I got immediate calls from most of the city asset managers and others around about how we might be able to model solutions together. And if I had given 100 presentations saying I got a model, I would have gotten one of those.
can do another one in the room, maybe staying over by the mic. Yep.
Thanks, Seth Jaffe, Philly. I have a question based upon one of Charlie's slides, but it goes broader to some of the issues that have been raised. The slide indicated that there's this feedback loop problem that insurers, in fact, are often investing their profits into some of these areas that are at risk. And that's not news, but it still blows my mind. And the question is, how big of a problem is market failure still at this point? Because just one more thing, Ben was talking about investing in areas where the insured is doing proper resilience planning, but you can't plan for resilience building by building. You got to plan resilience by municipality or region or everything. What's the point of insuring a building that's sustainable if it's the area is not sustainable? And it just seems like there is a broad question percolating through the room in part about the extent that insurance markets are actually working. Are they working? And if not, how do we make them work?
Oh, I'm happy to take it. I mean, it is a market failure, I believe. If you look at the level of protection gaps, they are much higher than healthcare was before kind of this groundswell of we need an Affordable Care Act that does all these things. And when we talk to the industry, you know, a lot of times they are like, well, it's not our job to manage the risk. It's true. And kind of what I said earlier is the risk to you isn't losing money because you are sophisticated and you can do these things, but you could be regulated like a utility at some point, and you could be irrelevant to customers. And you're seeing the level of, you know, when you hear community people talk about, like, my insurance went up and I don't have insurance, and then we had a loss and I got all these things. It is, you know, the industry is run by, you know, often actuaries and lawyers, and that's a good thing because it is very important for the industry to be solvent. Like, if it's not solvent, it all collapses too. So there is this market failure dynamic, which is kind of what I got back to, is like the solution isn't that the industry is going to save anybody. That can't happen. They can't do it. And they're like, everybody's looking to them. So I understand the kind of fear on their part, but we need to come together and fix the whole system. And it requires public-private kind of new ways of thinking. And I think there's enough pain kind of coming through, you know, getting back to Senator Whitehouse's presentation. And I think I think people in the industry are like, yeah, we need to kind of engage a little bit more to maybe fix the system, but it needs to be fixed, and we should be collaborating now to do it, or else the kind of the policy changes are going to be dramatic and affect the industry. It's kind of my 2 cents, maybe 5.
Well, Dr. Bagg, I know you've cited some statistics about, you know, for every resilience investment, how much is going into flood-prone areas. Maybe I'm prompting you here for perspective on, you know, the influencer role of insurance.
Well, yeah, I mean, I do think insurance plays a huge role in sending signals. And in that regard, I think could do an even better job in that regard. And right now, you know, as I alluded to a bit in the talk, I think that we're going to be lessening the role that federal and state regulators play in decision makers play in determining where we're going to build and rebuild. You know, you're seeing a lot of that. You're seeing that in the loosening of standards, understandably at some level for post-wildfire rebuilding and the like, and we're seeing that dropping in the FEMA standards again. So basically, we're moving out of some of the traditional roles and helping people reduce risk, think about that in that regard. And so the availability and pricing of insurance is going to be a major signal in that regard. And I also think, although this is not a way that the industry sort of characterizes this, that can often have very positive benefits for nature. That's not the principal thing that we should be worried about here. I'm very worried about people and property and their safety. But if we're essentially making it difficult to get insurance on top of wetlands, then that's a good thing for nature too. If we can stop building in the lowest lying high risk areas on top of our first lines of defense and allow those to recover, and we were sending signals that that's actually a pretty important thing to do to reduce risk to people and property, that would be a good thing. Ditto for wildfires and the areas that we're building right up against large forests. I worry a bit about some of the discussion and the emphasis on hardening, because that only makes it more possible to build in those areas. And maybe we ought to focus a little bit more of our signal on exposure reduction. I'll step off the soapbox now.
We're going to take another one in the middle here. I've been neglecting the middle.
Hello, thank you. My name is Gabriela Bocio Santos at the Sustainable Solutions Lab. I have a question for Theodora about renters. How does your program approach renters, and how do these shocks affect renters? Like the landlord might have insurance or whatever, but like, what are the effects on renters?
It's a great question. I may have mentioned this, I may not. Our organization focuses specifically on homeowners, working class folks, mostly in the outer boroughs, certainly Manhattan, although not as much. So with that in mind, we developed the program specifically for homeowners. Part of the eligibility criteria requires that you own a 1 to 4 unit home. So this isn't a program, we don't work with folks who own sort of like massive properties, but it's a 1 to 4 unit building. So it's a tough question because renters are particularly vulnerable to flooding. They don't often have insurance, and they're in a large part left out of all of these conversations. Because our organization's mission is homeowners, it was a programmatic decision that we made, but we tried to put some sort of stopgaps in place to ensure that homeowners have to invest in, well, they can use the money for whatever they want, but there's education in place to remind people that you do have tenants, you do have an obligation to keep them safe, and you can make adjustments to your building in order to ensure long-term sustainability. But at this time, it's a bit of a tricky one. I'm hoping that after a few deployments, we'll be able to, we are at sort of liberty to change the programming however we want. It's at our discretion, but only after a few deployments and case studies, we'll be able to know exactly where to make improvements. And while I don't want there to be like a terrible event, it is important to have some examples of things to review in order to make improvements. So renters honestly are not really part of the program at this time, but focusing on small homeowner landlords specifically is a choice that we made to try to not completely exclude them from the conversation, but it's just the mission aligned with the organization at this point is for homeowners.
Appreciate highlighting that gap. I think we have virtual next.
Appreciate the discussion at a macro community/regional scale. How is insurance looking at major privately held infrastructure relative to climate change? For example, dams come to mind as private infrastructure with significant broader public risks.
I would say that they can be clients of insurers, and they are a part of how we evaluate all opportunities. So they would be considered just like public infrastructure. Private infrastructure is another investment that we can make. And I would say, we also have an asset management side of insurance, and that can be a part of our investments as well. We are heavily regulated, though, in that space. And so it does make those investments a little bit more challenging because of the liquidity requirements. But we have made investments in public housing. And so, I think that is another component of how we think about overall resiliency efforts.
Just to add to that, one of the areas where we do see a lot of opportunity to work together in this interface is often with privately held large hotels. So, for example, in the Caribbean, opportunities to ask how restoring and enhancing reefs and mangroves, could affect both their risks and their premiums. So a number of those discussions and some activities ongoing at the moment.
Right, another one in the room. Take over here.
I'm coming, Emma. I'm tall. I have long legs. Oh, thank you.
I have short legs, so I can do it. Hey there, I'm Emma Gildescame from the Nature Conservancy, and I think it's really important, Theodora, what you were talking about with keeping people in their homes, especially low and moderate income homeowners. But the reality is that a lot of the places that people are living now are not safe now and will only be more unsafe in the coming years. And also, voluntary equitable buyouts in those homes can help open up opportunities for nature-based solutions that help protect the rest of the community behind them. So from all of you, what is the role that you see insurance and either innovative insurance products or market signaling through insurance rates in helping facilitate equitable buyouts that leave space for safer communities at both the individual and kind of community level?
I'll take it. I think kind of a core principle of insurance has historically been, bring the policyholder back to where they were. And I think there's ways to kind of really look at the way both policies are constructed and claims are handled to say, like, this makes no sense when we know like so much in mitigation needs to be invested in, to say, how can we build in policies to actually build things back better and kind of accelerate the trends, investments in mitigation.
Yeah, and I think that's an opportunity to explore, is to make sure that when there is a loss and there is a payout, that we are not incentivizing building back in the exact same place that was at risk and maybe even at more risk now. So that is a policy pursuit that is worthy, and we don't want to then rewrite that policy, and which maybe becomes now more unaffordable. So I think there's a feedback loop there that should be able to address sort of that long-term outcome.
So there was a recent paper, and this is partly what Kyle was alluding to, and you'll have to email me later for me to remember who the authors were, send it to you. But for kind of all of the focus on buyouts, and this was a study in North Carolina looking at the buyout plans there. While you're absolutely right on the existing properties and existing risks and the like, the problem is that we're still building anew in riskier areas. So we have focused a fair chunk on the buyout piece of this, and very important. So I'm not trying to downplay the importance of that. But that study from North Carolina showed for every buyout that there was in the state, there were 10 more properties built in high-risk flood areas. So it really is still the building problem that we're up against first.
All right, so I am going to acknowledge the time. We are lucky that all of our panelists could stay a little while longer, but if you do have to get up and go, no problem. But we are going to extend this for a few more minutes. So if there's another in the room, I see one over here.
Thank you. My name is Sarah Doss. I'm a climate scientist at Woods Hole Oceanographic Institution. I really want to thank all the panelists. This has been illuminating. So I guess I want to touch on, the change word in climate change and circle back to White House's comments at the beginning. Climate change is here now, but it's coming faster and faster. The future, it's going to be even worse. But the future isn't written, right? So the next couple of decades, we sort of can make predictions and understand what we're going to see in terms of warming or sea level rise, droughts, extreme rainfall. But past mid-century, what scenario we're on, what the future looks like is entirely dependent on our future carbon emissions, which is what's driving all this change. Everything from like the examples that Michael raised about using reefs and nature solutions. Well, above 2 degrees global warming, almost no coral reefs in the world will survive the changes in the ocean. Similarly, thinking about sea level rise, by 2100, the city of Boston will exceed its flood limits almost every single day of the year, right? If we're on this emission scenarios that we're on now. So I guess I'd ask, the panel to, have provide perhaps some insight. What role do you think large industries, insurance industries play in, you talk a lot about risk reduction and mitigation, but I'm not hearing anything about the largest lever in the room to reduce future risk and mitigation, which is to reduce emissions and this change the future scenario that we're all facing. Thanks.
So Swiss Re is a Swiss company, and we believe in climate change, and I think we have a target of 2050 as part of our sustainability plan to completely decarbonize all of our portfolio. So while that is still a ways away, that is part of our industry's effort or our company's effort to de-risk from carbon emission producing industries.
Okay, I'm going to push back just a little bit here for a variety of reasons. I would say, do we need to be more aggressive in our mitigation actions? Yes, but I also think that we have been, as a group of climate scientists and activists, pushing to do more to protect people, property, and nature in 2050 than we're doing now. And that, to me, is part of the fundamental problem. And the reason why there is often lack of support is because we're not recognizing well enough the needs of adaptation right now. And that's what I think we should be focusing more effort upon, and that there is agreement in that regard. I carry some of the same concerns that you do about what the future of nature may be. But honestly, nature is more resilient than our civil institutions for the most part. So I have more concerns about our institutions than I do for nature per se. Hey, the good news is you'll have coral reefs here. So coral reefs themselves are not disappearing. They're going to be changing their structure, places. But the most important message of all of that is that I think the kinds of messages that we hear all the time is that we need to recognize the pain that people are feeling now and focus on adaptation efforts with that same kind of gusto sooner rather than later. And there will be common ground for that, where there isn't always common ground yet for some of the future actions.
All right, I think we have a virtual one coming next.
This question is from Cabell E. It is my understanding that insurance companies don't incentivize resilience in development. How can we encourage an adjustment to that approach?
I don't know what he quite means by don't incentivize. I would say, one way that we are signaling that we support resilience initiatives and, building to proper building codes is that, that is where our capacity is being deployed. So I think that is a signal that we are sending. We also, invest in the Institute for Business and Home Safety, which I think is a sort of a leading group that sort of thinks about building standards and sort of what we want to see when we are writing that risk. So I would say there is incentives in our structure. So maybe the question is more sort of what is the next step of that? What else could that look like?
Yeah, I think that's right. I think there are incentives. They're not enough. They're not focused kind of hyper locally. There's a lot of opportunity to improve, but there are incentives in the system.
As I wrap up here, every speaker here has given their contact information, and they might be around for a little bit afterward. I think I want to hear, to wrap us up from all the panelists, maybe end on a challenge, which is we've heard, very appreciatively the candidness about system is broken. This is a, what needs change question for you all. So who or what stands in the way? Maybe you're challenging one of your other panelists, or how has your own kind of theory of change changed over time?
I can start. I'll go back to that City Hall example where, I was sort of drawn to the industry's impact and our decision to invest in a deployable flood barrier at City Hall. But it's sort of that next step of like, well, if we can do that, if we can prove that case study, how can we expand that to other mitigation investments? what is the role that we're going to play as insurers, and what is the partnership that we need to have with public and private entities to sort of make that happen. But I think there's, I think we're smart enough to do that, and some of it is just getting the right people in the room to have the conversation. So I've done a lot of work internally trying to just talk to our underwriters and understand how they, take the models and then go through their underwriting process. But I got to believe there's a way to do it, and I think there's some opportunities there to sort of to solve that piece.
I'll go next. I don't really have an answer, so I hope this doesn't sound too rambly. What I think about all the time in my organization is how do we connect people with financing? And that's something that comes up time and time again. And so a challenge for a lot of the folks in our communities is we know that this is a problem. I know I'm at risk. I can't afford to move. So how am I supposed to afford all of this? And so I would say if there is a way to connect people to financing so that they could make some of these improvements and not have to move, or learn a little bit about what like a managed retreat might look like for them, but then how do they set up in a place that is near where they work and near where they can raise their kids, and so that they can have their own communities in a different place. I don't know what that looks like, but I would say without that piece, I don't know, it's really hard to think about how to actually give people what they need if you don't also have like the money to do it.
I will echo that. I think if there's opportunities for you to collaborate across traditional boundaries, take them. Ideally, they are, we think, starting local and kind of working up to try to solve some of these problems on a small scale. And to Theodora's point, if you have the ability to finance some pilots and demonstration projects and things where we can test and learn, that's how this is going to change. I think there's certainly kind of large scale, kind of huge policy issues, but I think in the current political environment, that's probably not going to work. And also, I think it is more efficient and effective to kind of test and learn, but we need to do a lot more testing and learning.
I just want to say thanks again for the opportunity. In terms of what the challenge is, I mean, I'll just echo again that the challenge is we need adaptation now. It's more critical than ever. Those risks are only going to increase. I think that's incredibly important. Specifically from an insurance side, as I illustrated, I think insurance does play a huge role in potential benefits to nature. It has been largely indirect and unintentional, and I'd be happy to partner to make it more intentional.
Awesome. Well, thanks so much, everyone, for sticking around. Again, I just want everyone thank our panelists. Did a great job, and we know they have a lot of questions. So, that I'll pass it back.
Thank you very much, Kyle. So many thank yous to give out our speakers, our organizers, Kyle, Ellen, and Kathleen. The forum organizers at large, Kelly Nee, Gabriella, myself, Jessamine, are on calls every single Monday to make these things happen. We have a recording that will be available. We will send it to you direct into your inbox. You don't have to go looking for it. It does take a few days. Stephanie, our wonderful video editor, kind of takes out the things that are, unnecessary and makes it a nice, clean video for you. We have feedback sheets on the table. They are bright yellow-green. Please let us know what you would like to hear from, what topics interest you. We legitimately read through all of them. Use that when our steering committee comes together to plan future forums. So please leave your thoughts for us on that sheet. There's a feedback survey link in the chat for those of you who are virtual. You can just leave your sheet on the table or bring it to the front desk, whatever works for you. We will recycle your name tag if you leave that with us. The next forum is June 6th. So put it on your calendar now, same place, basically the same time. And it's on social vulnerability and climate resilience. So it's a really good follow-up topic to insurance. Intentional. Yes, it is. So again, let us know your thoughts, your feedback. Thank you so much for being here, for taking time out of your day. Apologies for the bit of the late start. We tried to make it up though, and I think we did a fantastic job, but let us know if we didn't. And we'll see you on June 6th at the next forum. Thanks.